Good morning, and welcome to today's meeting of the SEC's Small Business Capital Formation Advisory Committee. I now call this meeting to order. I want to extend a warm welcome to everyone. We also appreciate members of the public who've tuned in to watch the meeting via webcast on sec.gov. Courtney, do we have a quorum for the meeting?
Good morning, Erica. Yes, we do have a quorum, and I'd also just like to add for any SEC staff that speak today, any views we provide are in their own speaker's official capacity at the SEC, but they don't necessarily reflect the views of the commission, the commissioners, or other members of the staff. So thanks for humoring me with your SEC disclaimer. Back to you.
Thank you so much, Courtney. So first, I'd love to take a moment to extend a very warm welcome to the committee's four newest members: Jennifer Newton, Rose Standifer, Wendy Stevens, and Emily Underwood. Jennifer is the founder and managing attorney of Start Smart Counsel in Miami. Rose joins us as a partner at the law firm Foley Hoag in Denver. Wendy is a partner at the accounting firm Forvis Mazars in New York, and Emily is a clinical professor of law and the director of the Innovation Clinic at the University of Chicago Law School. Really amazing backgrounds, and I think they'll be so incredibly additive to the committee. We're really looking forward to having them participate. These four members were appointed to the commission only 2 weeks ago, so we really appreciate them making the time to join us today on very short notice. On behalf of the rest of the committee, we truly look forward to working with you, and we appreciate your commitment to service. Stacy, would you like to say a few words?
Sure, thanks, Erica. Good morning and welcome, everyone. Thanks for being here at this slightly early hour. I'd also like to extend a warm welcome to our four new members, Jennifer, Rose, Wendy, and Emily. We're excited to have you on board and look forward to hearing from all of you. Lastly, Commissioner Crenshaw asked me to extend her apologies for being unable to attend today's meeting and looks forward to meeting the new members at the next committee meeting. With that, I will turn it back to you, Erica. Thanks.
Thank you, Stacy. So today we're going to continue exploring ways to support early stage capital raising with a focus on investors and managers. I have a full agenda anchored around understanding how certain investors raise money and the challenges facing emerging fund managers, which are managers on their first through third pooled fund vehicles. We'll begin by discussing how venture capital fund managers are raising capitals, including the limits of arm's length fundraising. We'll hear from Dr. Sabrina Howell, who just published a paper regarding her research on trends in VC fund managers' Rule 506C, a capital raising exemption that permits general solicitation. Dr. Howell's report assesses how VC managers use Rule 506C exemption as compared to the more commonly used traditional private placement exemption, Rule 506B. The report also compares the types of fund managers that choose to use each offering pathway. I had a little chance to dig into the report before this meeting, and the data is very interesting. I'm excited for Dr. Howell to present her findings and hope she'll discuss some of the advantages and challenges of public advertising for traditionally underrepresented managers. Next, we'll hear from SEC staff members from the Division of Investment Management, who will provide an overview of the registration framework applicable to private fund advisors and their fund, including exemptions from registration requirements. Both of these topics will help provide us with a better understanding of how funds raise capital and the regulatory environment they operate in. By learning how different types of venture funds are accessing capital, including emerging fund managers, we can better assess how the regulatory pathways for capital raising are functioning and whether any improvements could be considered to reduce friction and improve efficiency. After a short pause in programming, we'll further explore emerging fund managers and consider how they can better be supported, including through fellowship and fund of funds programs. We've spoken before about and most of us are familiar with incubator and accelerator programs for entrepreneurs, but not everyone is aware that these sorts of programs also exist for fund managers. Programs like which we'll hear more about this afternoon, are intended to promote fund manager development and growth by offering guidance, resources, and networking opportunities to develop emerging managers and their funds. As we know, the entrepreneurial ecosystem relies on a variety of investors to be available and interested in investing in different kinds of companies at varying stages. Emerging fund managers play a critical role in investing in early companies as they manage smaller funds, writing smaller early checks needed to get a startup off the ground. A larger and more diverse pool of capital providers leads to greater investment in a wider variety of founders. So helping these investors find footing and successfully raise funds is important to our economy. But before we get to this exciting agenda, we are so pleased to have Chair Gensler and the commissioners join us. Chair Gensler, thank you so much for being with us this morning. Would you like to start with your remarks?
Thank you so much, Erica, and good morning, everybody. I'm pleased to be with you. And it was already said that I'm speaking on behalf of myself in my role as chair, not for my fellow commissioners or staff. I do want to welcome the 4 new members, Jennifer, Rose, Wendy, and Emily, to the committee. I thank each of you for your willingness to serve. You'll find at advisory committees, you get together and you network, but also together you can give some really important advice and thoughtfully sort of weigh in on what this commission is doing. And so I appreciate that, and I wish you well in your tenures. Look, the committee is focused on 3 topics, ranging, as you heard, from venture capital fundraising to exemptions from private fund advisors and the challenges faced by new managers. It all kind of boils down to access to capital, and access to capital, particularly for startups and small businesses that are at a different stage of their development. And with regard to the first topic, venture capital funds play a really important role in alternative capital raising. I think it's one of the United States' comparative advantage that we have such a deep and I would say long history in the venture capital field. But their advisors also give advice to the startups and entrepreneurs themselves. So it's both the capital and the advice. Small and early stage funds often start out raising money from friends and family. These are the funds themselves, not the companies, the funds themselves starting out trying to raise money from friends and family. Success, though, often means eventually outstripping those friends and family for the fund managers. And that's why it's important just to hear from you all, whether it's relationship-based fundraising, public advertising, how these can play critical roles at different stages of the funds raising money so that they can invest in, startups. These fundraising methods have helped develop a vibrant private markets alongside our robust public markets. I often talk about how, our public markets are large. Our public equity markets are approaching $60 trillion, but our private funds market is deep and is larger than our entire banking system. And venture capital and private equity and private credit all play an important role in that. I think that Congress understood this. They included in the Investment Advisors Act of 40 and the Investment Company Act of 40 certain exemptions from advisor registration from being an investment company, and that included venture capital. In addition, I understand the committee is also going to hear about the challenges facing new fund managers. the fund manager starts up, how do they proceed and be successful? And a core principle of our securities laws is about fairness and access, regardless of anyone's background, color, gender, geography. Anyone who wishes to access our capital markets, whether it's to start a fund or to actually get one of those funds to invest in them, should have the same opportunities to do so. And I look forward to hearing about how the SEC can best support those who are just starting out in the fund management business. But I thank you. I look forward to hearing your advice. And I think I'm supposed to probably turn it over to Commissioner Peirce.
Thank you.
Thank you so much, Chair Gensler. We really appreciate that. And thank you. Welcome, Commissioner Peirce. We'd love to hear your remarks.
Thank you, Erica, and thank you, Chair Gensler. I'd like to extend my congratulations to the new members of this committee as well. Welcome to Jennifer, Rose, Wendy, and Emily. I look forward to your individual contributions to this committee and appreciate your willingness to serve. And thank you to the rest of the committee and our guest panelists for being here today. A belated thank you to the committee for your recommendation that the Commission increase the crowdfunding offering threshold at which reviewed financial statements are required from $124,000 to $350,000. Such a change could help make crowdfunding a viable fundraising avenue for more small companies. And thank you also for your observations at the committee's last meeting on the state of small business capital raising. I found those to be very illuminating and would welcome similar discussions at future meetings. To be effective, capital markets must be able to get money into the hands of good managers, regardless of whether they have rich friends and family. Only then will investors' funds find their way to the companies that can put those funds to their best use. Today's panels about emerging fund managers will help us explore ways we can lower barriers to entry for such managers and thus ensure that their expertise is being drawn upon to deploy capital. The first panel will discuss the underutilization of Rule 506C under Reg D, which allows issuers, including funds, to publicly advertise a private offering, provided that each purchaser is accredited and that the issuer takes reasonable steps to verify that accreditation status. Most recently, issuers raised around $169 billion under Rule 506C, which compared to $2.7 trillion under 506B, which does not permit general solicitation. I have a few questions for your consideration during today's meeting. According to Professor Howell's paper, an average of only 8.4% of venture capital funds have used general solicitation since 2013. Based on her paper, one of the reasons for the lack of interest in 506C seems to be the cost and legal risk that's associated with the reasonable steps to verify requirement. How could the Commission mitigate these costs and legal risks? Should we allow an investor to self-certify her accredited investor status? Professor Howell's paper also suggests that the use of 506C may send a negative signal to investors that the fund is incurring the cost of 506C only because it doesn't have the requisite personal network to fundraise without general solicitation. Would reducing the cost of verification sufficiently address this negative signal? The paper posits that reforming Section 3C1 of the Investment Company Act could expand the use of Rule 506C because the 100 investor cap that applies to 3C1 private funds creates a regulatory barrier to 506C managers' access to small-time retail accredited investors. Where should the cap be set to address this regulatory barrier? Congress, in the Economic Growth, Regulatory Relief, and Consumer Protection Act, created a new exemption for qualified venture capital funds under Section 3C1 of the Investment Company Act. Those funds can raise capital from up to 250 investors and up to 12 million of aggregate capital contributions and uncalled committed capital. What types of businesses and investors do qualified venture capital funds typically serve? Would a higher cap on investors or capital raise increase the usefulness of Rule 506C, expand access to investing opportunities for smaller or less connected investors, or help fund managers access the capital they need? If so, what should those caps be? And what else can the SEC do to create a regulatory environment in which talented emerging fund managers, including those who don't have wealthy networks, can get a competitive toehold? Thank you so much, and I'm looking forward to today's discussions.
Thank you so much, Commissioner Hurst. I really appreciate your thoughts and guidance on our action. I'd love to invite Commissioner Ueda for remarks.
Well, thank you, Erica, and good morning. First, I would like to echo Erica and my fellow commissioners to extend a very warm welcome to the newest members of the committee. I appreciate your commitment to public service and look forward to your contributions to the committee's work, which in the past has included recommendations on the accredited investor definition and regulation crowdfunding, as well as looking at changes to the Small Business Investment Company program. Today, the committee continues to discuss important issues, including how venture capital funds raise capital, the Section 3C1 exemption under the Investment Company Act of 1940, and the challenges that emerging managers face in raising capital and finding investment opportunities. As you will hear about in more detail from Commission staff, Section 3C1 permits a private fund to raise capital without registration, provided that there are 100 or fewer beneficial owners, and the fund is not making a private offering. Section 3C1 also provides, under certain conditions, that certain venture capital funds with less than 12 million in aggregate capital contributions and uncalled committed capital are not required to register, so long as there are 250 or fewer beneficial owners. Private and venture capital funds can provide non-traditional funding to small startups to help them innovate and grow. I wonder, however, if Section 3C1's 100 investor limit for private funds remains appropriate. This limitation dates back to 1940, while the venture capital exception was promulgated by Congress in 2018. Much has changed since 1940. In some ways, it may be easier for smaller funds to raise capital, considering that they may engage in general solicitation by using the internet or other means, if all purchasers are accredited, among other things. However, the 100-person investor limit may be too small to effectively contribute capital to small businesses or to be successful as an ongoing fund. I look forward to hearing about the committee and guests' insights about smaller private and venture capital funds, emerging managers, and how to facilitate capital raising for small businesses. During my time here at the Commission, I've been particularly concerned about the lack of an appropriately tailored and the potentially disproportionate compliance burdens placed on smaller advisors that are starting out. This can be a significant barrier to entry and a hurdle for emerging fund managers. So I appreciate that you put this on your agenda today. Thank you again to the committee for your continued commitment to small businesses, and I hope you have a successful and productive meeting.
Thank you so much, Commissioner Ueda. We appreciate your thoughts. And I'd love to invite Commissioner Lizarraga for remarks.
Thank you, Erica, and good morning to everyone. Thank you, Chair Gensler, and to my fellow commissioners. Thank you as well. It's a pleasure to welcome the 4 new members of the committee today, Jennifer, Rose, Wendy, and Emily. As you know, this is one of the 2 committees created by Congress to advise the Commission. And through your membership in this committee, you will take on the important responsibility of advising the Commission on matters relating to small business capital formation. With access to capital being an enduring challenge for millions of small businesses, particularly in our country's most challenged, underserved areas, this advisory committee has a unique opportunity to inform and to improve the Commission's ongoing work in this space. It's encouraging to see that you will hit the ground running with discussions on how we can better support emerging fund managers that do not have access to the traditional relationship-based networks that the larger VC fund managers regularly make use of. This is the priority that warrants greater attention, especially in light of the unique challenges that are involved. I think we share the common goal of promoting capital formation in the broadest, most inclusive way possible. So your service in this committee is an opportunity to advise us on how best to leverage our resources and our legal authorities to meaningfully achieve this goal. The presentations on the limits of arm's length VC fundraising and on ways to support and promote emerging fund managers through fellowships, particularly for women and racially and ethnically diverse managers, will be especially helpful. in fostering an inclusive investment fundraising environment for emerging fund managers, and by doing so, also helping diverse, underrepresented fund managers and the entrepreneurs whose startups they fund, I encourage you to bear in mind the importance of protecting retail investors in our private markets. That said, I look forward to the fresh, thoughtful perspectives that each of you will bring to today's discussions. Thank you again for your service and for your contributions to the advisory committee.
Thank you so much, Commissioner. And I want to thank the Chair and all the commissioners for these very helpful remarks. So jumping into our first topic today, I'm really excited to introduce Dr. Sabrina Howell, who will present her recently published academic paper examines venture capital fund manager use of relationship-based versus arm's-length public advertising venture capital funds. One of our goals will be to try to understand more about how venture funds and capital and rely at the National Bureau of Economic Research. Dr. Howell's research focuses on entrepreneurial finance, private equity, innovation, fintech, and China. A theme across her work is relevance to policymakers and practitioners. She received her BA from Yale University and her PhD from Harvard University. While regulatory policy now permits public advertising in certain exempt offerings, it's my understanding that most VC funds are still raising capital the old-fashioned way, by relying on their personal networks. But not all talented managers have a personal network to draw capital from. So I look forward to learning more about the benefits and challenges of public advertising and the committee's discussion on this topic. Welcome, Dr. Howell.
Hello, everyone. Can you hear me okay?
Yes.
Okay, terrific. Well, it's really great to be here, and I'm excited to share my research with you, which was funded by the SEC, but conducted entirely independently. And as I go through the presentation, I hope folks will jump in with questions. I'm not sure what your normal process is, but in academic economics seminars, we interrupt all the time. And so please just like shout out if you have a question, and I'll stop speaking. Or if there's like a hand raise process, you know, Erica or someone else can go ahead and interrupt me if I don't see it. Okay, so
thank you for that permission slip. I'm sure the members of the committee will be happy to do so.
Great. Okay. Now, oh, hold on a second. I'm sorry. I am a little bit new to WebEx. I've got to close all my PDFs other than the ones I want to share. Let's see. All right, hold on one second. Okay, let's see. Here we are. All right. So I'm going to present a project called VC Funds and Regulation D's Rule 506D. They're permitting general solicitation, open the door for emerging and underrepresented managers. And my co-author here is Dean Parker, who's a PhD student at NYU. So probably the most important friction or problem that economists think about in capital markets is information asymmetry. That is, one participant in a transaction knows more, for example, about the quality of his company than the other participant who might be an investor. And so because you can't perfectly observe, for example, the quality of a new venture, participants rely on imperfect signals. And those signals kind of take two forms. One is what we call soft information, which mostly comes through personal and local relationship networks. So think about this as like the trust that you have in someone you went to school with, that you think that they're kind of credible. The second is track records. So this is hard, what we call hard information that you can project across space to strangers. So if you have successfully brought a company to IPO, that's a type of hard information that everybody, even far away who don't know you, can observe as a kind of signal of your quality. So there's sort of a perception that these don't fully address the problem. Like these sort of imperfect signals don't allow all investors all the time to, for example, see which projects are scams. And that's, and of course, that's especially true in private markets, which by definition have limited disclosure. And so this brings us to what I consider the key tension in securities regulation, which is a desire to protect investors, but also to enable broad and inclusive capital formation. And so the key kind of, how does this like, let's translate this to kind of policy on the ground. So the key policy context that I'm going to be working with is the private market regulation, where to avoid having to register securities with the SEC and undergo a lot of disclosure, issuers use what's called the Reg D, typically Rule 506B exemption. And this 506B exemption is really important. I suspect a lot of you know it accounts for more fundraising than all public US equity and debt offerings combined in recent years. It bars issuers from publicly advertising, requiring them to rely on personal networks. So essentially it's going to try to protect investors by preventing public advertising, and essentially require participants to use soft information, these personal relationships. So this was seen as perhaps limiting that broad capital formation goal. And in 2013, Congress created this new exemption, 506C. And to try to achieve this broader capital formation, it said, okay, you can publicly advertise, or called general solicitation. But we're also going to, as we take one step along one of our goals of capital formation, we'll also take another step towards the other goal, which is protecting investors. And so it had some additional requirements relative to 506B. One is that all investors had to be accredited, whereas in 506B, 35 can be unaccredited. And it also required issuers to take a reasonable steps to ensure accreditation, versus in practice, the way 506B works is that issuers take investors at their word. So the main findings of our project, and I'm going to go into a lot of detail later, but this will give you kind of the high level, is that take-up of 506C has been pretty low, just 8.4% of VC funds since 2013. Further, there were higher take-up rates, and we don't see any worse performance among underrepresented managers. We show that personal and particularly local networks matter in fundraising. We do this in a couple of different ways. One is that we show in a survey.
Sorry, I'm gonna take advantage of your offer to allow me to interrupt. Can you tell us how much higher was the take-up rate in underrepresented managers?
Let me come to that in a few slides. Okay, let me come. I'm gonna show you exactly those figures. It's very significant once we control. We'll control for where the state and the time, and then we find very, very large results in terms of higher take-up. So, however, there's a big however, which is that even though take-up rates of 506C was higher among underrepresented managers, the actual overall sort of needle didn't move much. That, managers, for example, who, didn't go to elite schools, like haven't actually increased that much as a share of all managers. And the reason is basically that 506C take-up is overall low, right? It's just 8.4%. And even within 506C, the share of these underrepresented groups are far below population benchmarks. So basically, even though they use 506C more, it doesn't actually sort of move the needle overall of sort of manager diversity in private markets. And we'll present three possible mechanisms. That may all be, we can't really say which one is the most important or what, and there may be others, but these are three sort of mechanisms that we find some evidence for in the data. The first is what we call a track record paradox, which is that 506C relies on hard information, right? You're publicly advertising. So by definition, if you're relying on public advertising, you're projecting your quality signals across space to strangers. And that means that you need a track record, because how else are you going to show that you have that you're high quality as a prospective fund manager? But it turns out that, and I think everybody will know this intuitively, track records and personal networks co-develop. There just are relatively few people who have a track record and didn't develop a personal network along the way. And so there's not as much demand for 506C. It's not necessarily solving this problem of allowing emerging managers to enter at scale. The second mechanism are regulatory barriers to accessing what we call the crowd, or small-time retail investors. And I'll talk more about those later. And then the third is investor verification costs. So as I mentioned, there's a little bit more of a burden on the issuer to verify accreditation in 506C. And this deters managers who don't need C from using it. And that in turn leads to a negative signaling equilibrium. So any manager who could avoid using C would do so because they don't want to signal that they essentially lack these personal relationship networks that would allow them to fundraise. We think there are two insights from this work that are actually broadly relevant to securities regulation and financial intermediation beyond this 506CB particular context. One is that efforts to protect investors from fraud can come at the expense of higher barriers to entry for issuers. And two, that track record matters at arm's length. That is when you're not, using personal pre-existing relationships to identify counterparties. But strong networks matter in relationship financing. And so what that means is that publicly advertising on its own is only helpful to the small fraction of prospective issuers who do have a strong track record, but also have weak personal networks, and so thus can't do relationship financing. Are there any questions so far? All right, I'll go ahead with the policy context. So I'm going to start with kind of just background on the securities laws. And by the way, Erica, I thought I had an hour. How long do I have until, or is it just until 10 or?
Jump in there and say that I think presenting through 10 works. You have till about 10:15. Just want to make sure that we all have time for Q&A.
Okay, so that's a little bit. Thank you. Thanks so much. That's a bit less than I expected, so I'll probably skip some of this, but happy to come back during questions. So the securities regulation, as you know, in the US is mostly through mandating disclosure, which creates burdensome costs for issuers. And so the longstanding compromise is you can either go the route of registering with the SEC, which implies lots of disclosure, or you can rely on an exemption, which implies no disclosure. And there was some regulatory uncertainty after this 1933 compromise about what it meant to not register with the SEC. And so in 1982, Reg D 506B was implemented, which provided this sort of safe harbor for using an exemption. And today, that is the basis for the entire private equity, venture capital, real estate, and hedge fund industry, which is raising the bulk of the capital under these exemptions. And then also for a lot of direct issuers, companies, startups, et cetera, with about 50 billion. Now, there are some conditions in 506B. So resale is a bit restricted. You have to notify the SEC. You don't disclose, but you notify that with this Form D that you're doing the offering. You're not allowed to publicly advertise, and public advertising has a pretty broad remit. It includes like mentioning at a conference where strangers are present that you're doing a fundraise. So what it means is that you have to have a pre-existing and substantive relationship with a prospective investor. And the concern is that this may entrench well-networked incumbents, creating barriers to entry. Then the last condition is there's limits on who can invest. So the Supreme Court established this as like people who can fend for themselves are the ones who should be able to invest in these private markets with limited disclosure. And in practice, what that means is that you have to have a certain amount of wealth or income, which has not been updated in a long time. And so now there's like 20 million Americans who would meet this accreditation threshold. And this is one reason we have more about this in the paper, but we don't think that there's like a limited supply of accredited investors, which is, that doesn't seem to be the problem. So 506C was trying to reduce this sort of incumbency benefit, expand capital formation to support small businesses. Became effective in late 2013, and it had these two additional restrictions relative to 506B. You can only raise from accredited investors, and you have to take some steps to verify investor accreditation. When we read the rule carefully, while it's pretty complicated, it doesn't seem that onerous. The issuer doesn't have to represent the investor as actually accredited. They just have to show that they took some steps. And the step could be as simple as an email from another accredited investor you've worked for that says, oh yeah, Erica is accredited. And if I have that email from my other investor, Gary, then I can go ahead and accept Erica as an investor. Okay, so we are going to study, I think you've probably gathered this so far. We're going to focus on venture capital fundraising. So not startups that are raising money to fund their operations, but rather fund managers who are financial intermediaries raising money from investors in order to then go invest in startups. Why are we focusing on VC fundraising? It's a far larger volume of capital relative to direct issuers or startups. VCs are key gatekeepers who determine which innovations progress and are commercialized in the economy. So who gets to be a gatekeeper actually matters for thinking about innovation. Third, managers are even less diverse than startup executives. And finally, it's relatively understudied in the academic literature. We're going to use the Form D data as a starting point, and we think essentially all VC funds use Reg D. So this is like a good proxy for the universe. And then we're going to match it to PitchBook data, which is the best commercial, commercial data source for VC funds. And we think by limiting our analysis to PitchBook matched funds, we have essentially a proxy of legitimate, economically relevant VC funds that have raised meaningful capital. And there are a fair amount of Form D funds that call themselves VC in the Form D, but aren't definitely not actually VC. And so we think that if you're really entering the VC market and you're raising meaningful capital, you're going to be in PitchBook. And so that's the data set we use. We also collect managers' LinkedIn pages and conduct surveys of venture capitalists and lawyers who provide counsel to VC funds. So let me talk a little bit about what I've mentioned the word underrepresented. So what do I mean by that? How are we going to get there? So the background is we think, personal networks, as I said at the beginning, are this mechanism to reduce information asymmetry. But we also have a lot of evidence that there's a taste-based dimension to personal networks driven by things like homophily. We all like people who are more similar to us, for example, or biases. And this could create a barrier to prospective managers from less well-represented backgrounds. They are thought to have weaker networks. There's evidence that VC managers are overwhelmingly, more than 90% white and male, and also, mostly graduates of elite schools. And that's going to affect what innovations get funded. So we're going to argue that we're going to use 4 different characteristics which we think are kind of proxies for having weaker networks. And we actually show that these characteristics are correlated with having fewer LinkedIn connections, which is a coarse proxy for, you know, your network. So the 2 demographic characteristics we'll consider are being female or Black Hispanic, and the 2 background characteristics we'll consider are going to a non-elite school or being a first-time manager. So the first thing we show is that the take up of 506C is pretty low, 8.4%. And the share, and this is not like just about VC, actually. We do look at direct issuers at companies in PitchBook, and their share of is even lower. And then the share in the raw complete Reg D with all this like little real estate funds and tons of kind of nonsense, but it's still only 10%. 506D. So take up has not been, this has not come in and like taken over as an exemption at all. This shows first how the fundraising has increased in recent years pretty dramatically, and that the share of 506C has, you know, increased moderately. There have been some large funds that use 506B, which means that when you volume weight it, the increase is larger. So there has been sort of accelerating take up in recent years, and we'll kind of see if it continues. So here are some summary statistics. So in the raw data, you can see that take up by underrepresented managers, which are down here in this bucket, is larger in 506C in the second column. For example, the share, probably the most extreme difference in the raw data is the Black share is about 1.5% in B and 3.9% in C, and so the difference is highly significant, which is what the stars mean, 2.4 percentage points. So now we're going to do that a little bit more rigorously in regressions, which allows us to control for trends over time, where these different groups have been trending over time, and we'll control for where the fund is. And what we find is that 506C funds tend to be a lot smaller. They're a lot more likely to be outside a top 10 city. They're more likely to be a first VC firm's first fund. And they're more likely to have non-pension fund limited partners and more individual LPs. And so this is kind of consistent with like not having relationships with the traditional sort of stalwart LPs of the VC industry and fundraising more from the crowd. We actually find that 506C funds don't perform worse. If anything, they perform better when you look at returns. We only have returns.
Could I ask a quick question on the previous slide? I think it said 3
Sure.
times more likely to use intermediary. Could you explain that?
Yeah, this column number 5, and this is actually the only variable I think here that's from the Form D data, which says whether they use a commission or a broker. And 506C funds are much more likely to use to pay a commission or use a broker, which means that they're actually using somebody to help them fundraise. And so with that's consistent with being more what we call at arm's length. Like you don't have, you know, if I know Erica from school and she's sort of been in my network, I just go to her directly. I don't use an intermediary to find her. But if I'm gonna try to reach people like her who I don't know, then I can potentially make use of a broker intermediary who might have those connections. And so we find that 506C funds are more likely to do that.
Hey, Sabrina, I got a quick follow-up question. Are you finding that those are retainer-based relationships or success fees based?
I don't know. All we have is a box in Form D that says whether they pay a commission or use a broker.
Thank you.
So
It would be interesting to think about, you know, necessarily how much that costs and, you know, how that potentially impacts expected returns. I have a little knowledge as a VC around how much these things cost, but I think particularly for much smaller funds, you know, wondering what sort of bite does that take out of the apple.
Mm-hmm.
Thank
that
you.
Would be fast. Yeah, that would be fascinating. I don't know of any data source about that. Okay, now so Eric, let me continue.
I'm sorry.
For what kind of? Go ahead.
Sorry. So one other sort of follow-up question before we're sort of on the topic of sort of like the general outreach. Do we have any indication of like when they are taking advantage of the general solicitation ability, what they are doing in terms of a general solicitation? Is that public advertisement, radio? Is it just speaking in more public forums? Do you have any clue of like what the end game for that taking advantage of it is?
You know, that is a great question. And in terms of what medium did they use to publicly advertise? You know, I think that's a great question, and I don't know. It's actually something we could have used. We could have asked in our survey, but we didn't. So I am not sure. My expectation would be in most cases, it's mostly posting on a website.
Okay.
Would be is what I've heard kind of from folks in industry, but it would be nice to have some data on that. It's a great question. All right, so let me go to kind of Erica's question about
Can I also ask a quick question? Apologies to interrupt. Did you collect any data about like the investment thesis of these funds? Like I'm in VC world right now, and there's sort of a turn away from the generalist VC fund, and also somewhat a turn away from funds that sort of claim to be like ESG generalists, as opposed to saying like we're going to do renewable energy specifically or deep tech and renewable energy. Like, do you find that what the investment thesis of the fund is drives it towards using B or C? And when you think about the lack of uptake of C, are you also seeing a downturn in funds overall being formed? Because I know there's a lot of contraction in the VC industry occurring right now. There's not a lot of new fund managers emerging kind of overall. And so is this really like a lack of uptake of C in terms of less fund managers, or or I guess the question is, are we seeing less fund managers overall, and does the investment thesis impact whether we're going to use B or C?
That's another great question. Unfortunately, we don't know. We don't have data on how the thesis affects what exemption they use, or if perhaps the need could go the other way too, right? The need to raise at arm's length might lead you to have a different type of thesis. And what we do find, and is here, I'm kind of, had skipped over a few things that you guys have now have zeroed in on. So here in column 6 and 7, we do have indicators for whether the fund has what we call a DEI target, which is, and then you can kind of imagine what that is, and then an ESG target, which is like more of a climate type goals. And 506C funds are much more likely to have these than other than 506B funds. So actually, in both cases, an average of 1.5% of all funds have a DEI target or ESG target, and 506C funds are about 2.6 percentage points more likely. So that's like 75% more than the mean. So it's definitely a big. They're much more likely to use these, which is, I think, this is a bit speculative, but part of what you're doing is you're able to kind of overcome some of that information asymmetry by having an investment preference that matches sort of non-pecuniary preferences of the investor. So for example, if I'm I am interested in funding like female-led startups, and Emily's the manager and she's a woman, I have homophily with her as a woman, which I can tell across space. Like I don't have to have a personal net with her to know that. And she's declared that she's going to fund female-owned startups. That kind of homophily and investor preference can pass through at arm's length and maybe compensate for the fact that I have less information about her quality and her whether, how committed she is to putting an effort into her fund, right? Which I would if I knew her personally. And so that's kind of a little bit of a way to potentially overcome information asymmetry. All right, so we do find, when we look at the fund managers, and here, we get race from LinkedIn pictures, which I actually have another paper that's published that shows that the algorithms that regulators use to predict race is for fair lending purposes is like really, really problematic, especially for Black people. And so I'm now only using coded images coded by American coders to measure these things. And so we find that that 506c funds have a higher share of female managers. 5.7 here, that's 5.7 percentage points, which is 39% of the mean. About 14, almost 15% of the fund managers in the overall data are female. Much higher share, as I showed you in the raw data, of Black Hispanic managers. 506c managers are less likely to have gone to an elite school and are more likely to be first-time managers. And I told you at the beginning that I think this who fund managers are matters for which innovations get funded, right? And so it has what we call real effects in economics. And here's some evidence of that. So when we look then at the portfolio companies that they fund, we see that the 506c portfolio companies are more likely to be outside the top industries for VC. So to the degree that VCs are kind of herding into particular hot industries, 506c is potentially creating some kind of diversity across industries. They're more likely to be far from the manager, and they're more likely to have a first-time or female entrepreneur. We don't see any result for the elite school, and we didn't collect race for the portfolio company executives because it's too it was just too difficult. Okay, so to sum up, we see that C funds tend to be smaller than their 506b counterparts, more often located outside of the big VC hubs, seem to be used by less networked managers, and have portfolio companies that are more likely to be in sort of underrepresented industries and tend to have more underrepresented leaders. So these are all characteristics that we think are associated with weaker personal networks. They're more likely to use general solicitations. We conducted a survey of fund managers and lawyers to kind of try to validate this in the data. And we do see that in 506B, 90% of managers who only use B report using their personal network to raise funds. Whereas in 506C, 40% of managers say they used 506C because they lacked a personal network. And I think that's actually a really large share, especially since there's probably some bias against admitting that you lack a personal network. All right, so let me show you some changes relative to kind of the pre-506C period. So this graph shows each bar is the change in that year relative to 2009 when our data starts. And so if we look, for example, at female in the yellow bars, the share of female managers has increased a lot. Like 2022, 2023, there's like 100% more female managers than in 2009. And a lot of that increase is coming in the more recent period post 2013. And you know, for the other groups, maybe a little bit less clear. We also see an increase in non-elite school managers and an increase in first-time managers in the darker colors. And then in I would say post 20, like in, let's see, the light blue is the Black Hispanic managers, and that starting in 2015, you start to mostly see increases, not in 2016, but especially in 2023. It was much larger relative to 2009, though it's pretty noisy because the numbers are so small. So a few people here and there can kind of move things a lot. But then what I want to highlight is that like what looked like big bars there when we look at the change relative to 2009 is not that significant at a sort of macro level. So this top graph here shows the share of Black Hispanic managers. The fully shaded bars are 506B, and the little bitty hatched bars here are 506C. And we see that the share overall Black and Hispanic managers has grown from about 4% to kind of like maybe 7% recently. And then there was a pretty big jump in 2023. But the line up here at 26% is the share of college graduates who are Black or Hispanic. And you can see that sort of relative to that benchmark, you know, there's not been a ton of increase. Similarly here, this is also about 60% of college graduates today are female, and the share of women among fund managers has increased. It's almost doubled, as I noted, but you know, still isn't close to that kind of college educated benchmark. Elite school has kind of the same pattern. Obviously, almost all college graduates went to a non-elite school, and elite schools are like IB plus, whereas the share of managers from non-elite schools has kind of inched up a little bit, but not that significantly. So what I take away from this is that there seem to be some entry barriers. Like there could be higher take up of 506C without a quality decline. And so we look for three mechanisms, and I'm going to show you just one cool graph, and then I'll wrap up, and I could happy to talk about the other mechanisms in the Q&A if you're interested. But the basic idea of this track record paradox is that managers with a track record kind of developed personal networks along the way. That is, a network and a track record are usually coincident. So, and so this leads us to two predictions, which is one, 506C fundraising success should be more sensitive to the track record than 506B, which we find to be the case in regression analysis. And second, that few fund managers are going to have this kind of sweet spot ideal profile for C, which is a weak network, but a strong track record. And I'll show you what that looks like kind of in the data. So what we've done here is we've put on the y-axis an index of how well networked you are. And here on the x-axis, your track record, basically. And then the red lines are the midpoints of each distribution. And what you and the blue bubbles are 506B, and the blue bubbles are 506B, and the orange bubbles are 506C. What you see overall is that 506C is weighted towards having a track record. So 81% of all 506B funds have managers that have a below midpoint track record, whereas only 54% of C funds are like to the left of the red line. And so it's true that like 506C relies more heavily on a track record. Now down here in this bottom right quadrant is the group that has a weak network, but a strong track record. And 506C is way more represented. 30% of this quadrant is composed of 506C. But the little circles are very small. It's a small share of funds. There just aren't that many managers who live here. And that's kind of the main
Sabrina,
point.
can I jump in with a question? So, you know, as a venture capitalist who's raised money from institutional LPs, I know that one of the very first questions that investors ask, whether it's, you know, a large endowment or just, you know, a regular individual accredited investor, is where will you get your deal flow? And there's a lot of emphasis put on, you know, do you have a large network? So, you know, I guess the question here is that from my experience, it seems that one of the, you know, major sort of qualifications to be able to do the job properly is to have a large network, because, you know, that's how you get exposed to investment opportunities. So, you know, how do you kind of think about that? That it seems to be, you know, something that people have historically considered an important qualification for your ability to successfully do the job.
Mm-hmm. Yep, I think you're absolutely right that is how it's seen. It's how you know, when I teach entrepreneurial finance, we focus a lot on thinking about the value of networks as in all different in a bunch of different dimensions. And so I think there's a couple of implications. So one, if being a good VC requires having a strong network in the entrepreneurial ecosystem, then it's not clear that allowing public advertising is going to broaden capital formation. Like it just might not be if that's the goal, is to allow people who like didn't go to top schools to become fund managers. It's just not clear that the right hammer to like hit that nail is general solicitation. Okay, so that's like the takeaway. That maybe instead you want to help people build networks or provide, you know, try to create these, you know, more hubs at state schools for new ventures, And that if you broaden the diversity of innovation hubs around the country, like then you will get more, start to get ecosystems and VC funds building up in those areas, like something like what we've seen in, sort of happen around Austin or Boulder to some degree. So it may be that that's kind of what's necessary, and this just isn't the right like tool for that. But I'm not.
Can I interrupt real quick? But I think that also presumes that the networks that you need to raise from LPs are similar or substantially overlap with the networks that you need for deal flow. And that may be one of the reasons why we're seeing really congested sort of the herding, as you put it, of which innovations are getting funded, where you can have two different networks. You may not have a strong network to raise from LPs, but you may actually have a strong non-top 10 city, unique perspective deal flow network over here, right? Mm-hmm. So I think you have to think about not all networks overlap for similar purposes.
Yep, that's absolutely right. And I think that I think that when we think about like who is using it, right? I think like to the degree you have, and this actually, I love that you raised this because I think it goes to this question of like, why is it more taken up perhaps by DEI target type funds, is that it may be that you have a network that is strong when it comes to deal sourcing. You know a lot of entrepreneurs, but you don't know a lot of rich people. And so
I guess the data that we're looking at here when people are categorized as low network is that only in relation to, I guess, accredited investors or, rich people, as we say? Because I guess we would have to differentiate.
So here we are thinking about, when I say people who we think have weaker networks, I'm focused on those 4 characteristics: first-time managers, non-elite school, women, and Black Hispanic, right? And then we also show that those are correlated to fewer LinkedIn connections. And we show that some of the results, like the graph I just showed you, my bubble graph, which I like so much, is like looks pretty similar if you have LinkedIn connections here on the y-axis versus having this index for our 4 characteristics. So that's what I mean by network. Unfortunately, I would love to see it. I don't actually see who you know. That would be very cool if we could see in our LinkedIn data. We don't see who someone's connections are, but it would be super cool if you could, right? Because you could start to see how elite somebody's connections are. So that would be awesome. If anybody here, works with LinkedIn, then and can connect me with them for better data, that would be super. So the second tension, I'll go.
I'm sorry to interrupt, Sabrina. I think Emily has her hand up.
Go ahead, Emily.
You're muted, Emily.
Thank you very much. That's embarrassing, the tech professor who doesn't use her tech correctly. So I wanted to bring us back to something that you talked about at the top, but since you kind of opened the door to talking about C and the sort of procedural steps, you mentioned that under B, a lot of fundraisers are kind of taking investors at their word as opposed to undertaking reasonable steps to confirm that they are in fact accredited investors, and that maybe this accredited investor diligence, I guess you could say, is like a bad signaler from funds that are trying to use C. But I'm wondering, maybe I'm thinking about this the wrong way, but can you give some examples of those reasonable steps that C managers are required to take that you think that B managers are not taking? And the reason I ask is, like, typically in our like fund formation process, we would require investors to like fill out an accredited investor questionnaire. They would have to give us some information. They would give us a bunch of reps and warranties in the investment docs that they are in fact accredited investors, and therefore they are taking all of the financial and legal risk in many ways if they are not in fact an accredited investor. And I would think those are the kind of steps that you're thinking about when you think about reasonable steps. And if that's the case, it doesn't seem like the delta between what C fund managers are required to do and what B fund managers are actually doing could be moving the needle that much.
Sorry, that the question is that B fund managers are required, that C fund managers are required to do more on the in terms of
well, I'm asking, I guess I'm asking,
investor
is it
investor
actually
protection?
the case that C fund managers are required to do more than B fund managers are actually doing? Because it seems like the delta between the two would be part of what is causing a bad signaling effect for C managers.
Yeah.
But if in fact B fund managers are actually doing those things anyway, I question how strong that negative signal actually is if these same high net worth or individuals are used to doing these things for B fund managers, which I sort of suspect that they are.
Yes, I think that it is hard to, so I don't know what is going on entirely in the background. What I can show you is that we asked 506B managers why they didn't use C, right? Because I think where you're getting at a little bit is that, like, if C is no more, if C were exactly the same as B, but just said, oh, you can publicly advertise, it seems like everyone should use C because it just creates an option. It's like there's always option value. Like, it means you can go to a conference and talk about your fund. Like, it just seems like that would be better for everybody. And so a question is, why don't they use it? And what this shows is the green is major influence, some influence is gray, no influence is red. And B managers were concerned about the time and money to verify investors and the legal risk and the negative signal. So all of those were kind of roughly equal in terms of major and some influence. And what we think it implies is that there was a bunch of kind of uncertainty about the verification and a sense of liability that was greater than in B, which I think, you know, if you're comfortable, especially for a manager who's already used B and is comfortable with it, it means that there is some switching cost. And so only funds that kind of really needed to use C would use it. And so in turn, that then signals something to the market that you're using C and that you need to do this verification. And so we think that this is kind of a one mechanism. And so even if as you said, like, even if B investors are sometimes doing the same things as C investors in terms of perhaps making sure their investors are legitimate, they might not want to use C just because of the kind of the sort of liability chill, if you will. I don't know if that answers your question a little bit. But the one thing I'll just mention is what is now the last mechanism is the fact, and this is, I think, this is a policy lever that you could easily adjust. So public advertising is most relevant for reaching retail investors, many small investments like the crowd. And most smaller VC funds are restricted to 100 investors, which means that it's going to be harder to raise a fund where you can make meaningful investments in portfolio companies, but everybody's investing like 50 grand or something, right? Because you're trying to target retail investors. And so this could actually constrain use of 506C. And we use an experiment where in 2018, if you had less than 10 million in assets under management, you could have 250 investors instead of 100. If you were raising more, if you had more than 10 million AUM, you're still capped at 100. And so we hypothesize that if this cap is constraining, if it's binding, then we should see that VC funds with less than 10 million AUM are going to be more likely to use 506C than larger funds. And that's exactly what we find. After the policy, there was a big increase in take up of 506C among smaller VC funds. So what it suggests, and we would imagine that if we could observe it in a causal way, the cap would be even more constraining for larger funds just because they'll tend to have more investors. So this investor cap does seem to be something that's limiting take up of 506C. Okay, so let me just conclude and kind of recap the main findings here. So we show that permitting general solicitation does help level the playing field for underrepresented managers, allowing them to escape the limits of their own geography in particular. And if you can reduce dependence of private fundraising on local conditions, you can potentially reduce kind of the geographic concentration and disparities in VC. However, the policy did not dramatically increase the ranks of UR managers. And we present 3 channels to help explain why 506C was not widely used enough to really move the needle. One is that track record paradox. The second is barriers to accessing the crowd via this 100 investor cap. And the third is investor verification costs, which seem to lead to some signaling problems. So let me stop there, and I'm happy to take any questions.
Great. And Courtney, I just wanted to check. I know we're a little bit over time. Do we have time for a couple of more questions, or do we need to move on to the next?
I think we should wrap fairly quickly. If there's one or 2 quick pressing questions, I think we could take it, but we'll just want to stick to schedule as best we can.
I think
Any
Karen
pressing
had her
questions?
hand up for a while.
Art?
Yeah, thank you.
Jennifer had her hand up.
I appreciate the presentation. I wanted to come to this paradox of track record and ask about how you think about attribution, because that's also a challenge for some emerging managers who may not be new time to venture, are coming from other places and may be challenged in how much of that track record they can bring with them.
You're saying that a lot of emerging managers don't have a track record, right?
Not that they don't have a track record, but how much of it can be, how do you attribute in a general solicitation if you have some restrictions on your ability to take that track record with you?
Oh, okay. So I'm not entirely sure what you mean by take the track record with you, but I think what it might help to explain how we measure track record, which is our preferred measure is previous successful exits of portfolio companies. So, and you see that if you go on AngelList and you look at the fund managers, they'll say if they have had exits, they'll be like, oh, I brought this company to IPO. That's that's just as clear as day. That's what we're looking for, is successful exits, big liquidity events that create returns for VC investors. We also look at people with a background in finance or who are previous entrepreneurs, is a much broader measure of track record. And then finally, we look at previous funds at the VC firm level, how many funds has your firm had, which is another signal. And so those are what we're those are what we're using. And so I think what you may be kind of raising is that somebody could have relevant experience that isn't widely recognized as a measure of quality by prospective LPs. And so it's sort of hard to translate that past experience. For example, if I, might say, oh, well, I could be a good VC because I've studied, I've done all this study and teaching of entrepreneurship and venture capital. So, you should invest in my fund. But you might be like, well, Sabrina, all that teaching is very nice, but I don't actually think that you have on the ground experience. So that is not there's not a useful track record.
No, actually, I'm making a different point, but we'll move on. I do think a lot of venture capitalists come from other firms, and sometimes they're limited in their ability to take that track record with them.
And thank you, Karen.
Yeah, but that's fine. That's okay. Good. I'm done.
Yeah, we can talk about that definitely in your portion. I think that's a great point to bring up. And Sabrina, I think you would probably be very successful in raising a venture capital fund with your experience. So just keep me posted on your future endeavors. And I want to thank the committee for all of these really thoughtful questions. This is an amazing set of data for us to look at to give us inspiration and guidance on making recommendations. So Dr. Howell, thank you again for joining us and sharing your paper. And we would love to continue exploring this information in regards to policy considerations later in the day. So thank you very much. All right.
Thanks so much. Good luck with the rest of the meeting.
Yeah, thank you. So continuing our focus today on funds and fund managers, I'm excited for us to spend a little bit of time getting up to speed on some of the other securities regulations that are relevant in the space, namely a handful of regulations under the Investment Company Act of 1940 and the Investment Advisors Act of 1940. Companies that are required to register as investment companies under the 40 Act are subject to reporting and other regulatory requirements. Many private investment companies rely on one of the exemptions from the definition of investment company set forth in Section 3C1 of the 40 Act to qualify for an exemption from registration. Now, I'm no expert in these rules, which is why I'm delighted to welcome the SEC's Robert Holoka, Branch Chief, and John Kavanaugh, Senior Counsel of the Private Funds Branch of the Investment Advisor Regulation Office, Division of Investment Management. Rob and John will provide a brief overview of the registration framework applicable to private fund advisors and their funds, including those exemptions from the registration requirements of the Investment Advisors Act of 1940 and the 40 Act, which may be relied upon by emerging fund managers. We think that learning about this framework will be invaluable for us as a committee and provide some great context as we continue to explore ways to support and promote emerging fund managers. Rob and John, welcome.
Thank you.
Hello. Thank you.
Hey, everybody. It's nice to meet you all. And Robert and I are excited to be here. Now, before I begin, I'll start with the standard SEC disclaimer that Robert and I are each speaking on behalf of ourselves. Corollary, we're not speaking on behalf of the commission or any of the commissioners nor the staff. I'll go so far as to say, I may not even be speaking on behalf of Robert. He can chime in and let us know if he disagrees with anything here. So again, super excited to be here. The purpose of our segment of the agenda is to provide a brief overview of the regulatory and registration framework applicable to private funds. And so our approach to the conversation will be three-pronged. We have the fund, we have the advisor, and we have the capital raise. We won't spend too much time on the capital raise, but it does seem to be a nice segue from the conversation that you all just had with Professor Howell. And so the only point I want to underscore here, and I presume that it was established at the beginning of your last segment in today's meeting, but just as a reminder, the offer and sale of securities has to either be registered with the SEC or subject to an exemption thereto. It applies to public companies, it applies to private companies, it applies if you're selling, private fund shares to a big VC fund, or if you're selling to grandma. And so the sort of primary regulatory exemption that private funds rely on is Section 4A2 of the Securities Act, which essentially creates like a private transaction exemption. And then Reg D, which constitutes 506B, 506C, those items that you just discussed, are safe harbors they're under. And so then that gets into all the different requirements that that you just covered. So 506B, no more than 35 non-accredited investors. 506C, which permits broad solicitation, general solicitation. You have that verification standard that I know you discussed at the end. Okay, so that's the capital raise. Now we have the fund and we have the advisor. And so again, we're dealing with the broad spectrum of securities laws, whereas the capital raise dealt with the Securities Act. The fund will look at the Investment Company Act. The advisor will look at the Investment Advisors Act. And so I'm not going to bury the lead. Private funds are not required to register with or otherwise be regulated as investment companies under the Investment Company Act. So the question is, what's a private fund? And in short, a private fund is an issuer of securities that would be an investment company, but for Sections 3C1, 3C7 of the Investment Company Act. So, sorry, I don't mean to overly complicate things, but we're looking at the Investment Company Act to determine whether or not a fund qualifies as an investment company. If it does, then the sort of rigorous strictures of the Investment Company Act apply. If it doesn't, which is the case with private funds, then it does not. It's not regulated under the Company Act. So, again, private fund defined as, you would be an investment company, but for 3C1 or 3C7. So the analysis starts with what's an investment company, and again, we're not going to dig too deeply into all this. This is not, a college lecture or anything like that. But just by way of introduction, an investment company is an entity that holds itself out as being engaged primarily in the business of investing or reinvesting or trading in securities. So far, it sounds like a private fund. So we look to the exemptions under the Company Act to sort of carve out private funds from Investment Company Act regulations. And we have two prongs. We have 3C1, 3C7. I think we'll spend most of our time looking at 3C1, but I'll just say by way of background that there are 3C7 funds which don't have a restriction on the number of beneficial owners you can bring into the fund, but it does have certain wealth or investment experience qualifications. So for an individual, a qualified purchaser, right? So 3C7 fund, it's limited to qualified purchasers. That's the threshold I just mentioned. So for an individual to qualify as a qualified purchaser, they have to have $5 million or more in investments. For an entity, that jumps up to $25 million. So perhaps less applicable to the sort of universe of funds that you all are focused on, but I just wanted to highlight it, particularly if you look at like really large asset managers and their funds, they tend to rely on 3C7. Okay, so that's 3C7. Now we have 3C1. Sorry. So 3C1, there are two prongs. So there's what I'll call the traditional 3C1 prong, and then we have the venture capital prong. So under the traditional 3C1 prong, the fund is limited to 100 beneficial owners. Can't have more than 100 beneficial owners. Fairly straightforward. And presumably many of you are familiar with this framework. Then you also have the qualifying VC fund prong, and there you're limited to 250 beneficial owners, so the threshold jumps up, which is helpful. But you're limited to $12 million in capital raised. And you also have to qualify as a VC fund. And I do want to get into what exactly that entails. And so among other things, to qualify as a VC fund, you have to represent to investors that you're pursuing a VC strategy. There are sort of general limitations on redemption rights, use of leverage, but then also perhaps pertinent to today's conversation, you can hold no more than 20% of your investments in non-qualifying investments. So that's a double negative. So essentially 80% of your investments have to be in qualifying investments. And a qualifying investment generally refers to direct equity investments in private companies. All right, so to the extent you're thinking of like a fund of funds example, that's that's not necessarily included. I realize I'm speaking to a computer screen, but does all this make sense so far? I'm happy to, yeah, okay, Stacey's giving me a thumbs up. Okay, all right, great. So we have capital raise, advisor fund, within fund, in order to not be regarded as an investment company so that you're subject to the Investment Company Act. There are multiple prongs to be accepted through 3C7, that's the really large funds limited to qualified purchasers. And then you have the two prongs of 3C1. So under the traditional prong, limited to 100 beneficial owners. Under the VC, 250 beneficial owners, but you have the $12 million cap, and you have this qualifying investment, rubric that applies.
And so I just want to confirm, so under 3C1, if you're in the traditional bucket, you're also must be investing in these qualified venture capital assets, and there's no limit on size.
Great. No, thanks for asking. And I know that I'm throwing a lot of information at you. No, so under the traditional bucket, it's VC agnostic. You
okay, so it could be anything in there.
Investment strategy agnostic.
Okay.
That's right. Only once you get into the qualifying VC prong do you start having restrictions over your investment strategy. Make sense? Okay, cool. All right. So that's the fund. And then we have the advisor, right? So recall that funds typically have an investment advisor with whom they're in some sort of contractual privity to provide investment advice to the fund. Now, investment advisors are subject to the Advisors Act, right? This statute, one of the sort of pillars of the securities laws, the Investment Advisors Act of 1940. But the extent to which the Advisors Act applies depends in part on the size of the advisor. So typically small advisors, right? Those with less than 25 million AUM, they're state registered. We'll get to what parts of the Advisors Act apply, but they're not registering with the SEC. They're registered at the state level, subject to state securities laws, etc. Mid-sized advisors, so those between 25 and 100 million, are also typically registered at the state level, subject to certain exceptions if they're not otherwise required to be registered with their state or subject to inspection thereto by the state. Then in that case, they would register with the SEC, but most of the time, these mid-sized advisors are registering at the state level. And then only once you get to the largest advisors, those with over 100 million in AUM, are you required to be registered with the commission, the SEC. Okay, so that's not the end of the conversation. Sorry for moving this paper around. We also have certain exemptions that apply to those advisors who would normally be required to register with the commission, right? So we're thinking the largest advisors. We have the private fund advisors exemption, and we have a VC fund advisor exemption. So for on the private fund side of things, if your AUM no more than 150 million and you're solely advising private funds, you're exempted from registering with the SEC. And then and now separately as a distinct matter, if you are a VC fund advisor, so you're solely an advisor to VC funds, and no limitation on AUM here, you're also exempt from registering with the SEC. So why is this pertinent? Because that definition, that second, right? So now we've got two prongs under this exemption to registering with the SEC for the largest advisors: private fund advisor exemption and VC fund advisor exemption. So this is sort of an analogous discussion to what we were talking about on the fund side under the Investment Company Act and 3C1. Now in the Advisors Act, we have these two prongs, and the VC fund exemption, in order to qualify as an advisor, you have to solely advise VC funds. The definition of VC fund is the same that we discussed earlier. So again, general limitations on redemptions and leverage. You have to market yourself essentially as being a VC fund, and then you have that qualifying investment rubric that we discussed. So typically direct equity investments in your portfolio companies. Does that make sense? I know I'm asking sort of just generally speaking. Okay. So
John,
yeah,
just to as we go through it, could you maybe give a little bit of insight as to like what it means if you are not exempt, what it means to register or to have to abide by the compliance regime for an investment advisor?
Yeah, thanks for the question, Bart. And that is a direct segue into one of the final aspects that I wanted to touch on. So to the extent that you are a large advisor and you're not otherwise exempt under the private fund advisor exemption or the VC fund exemption, or a number of others that we haven't, we're not covering here, you got to register with the SEC and you're subject to its regulation. And so, like the breadth of its regulation, we're not intending to cover here because that would take way more than 9 more minutes. But I should say, and I'm glad that you brought it up because I did want to highlight the fact that for investment advisors that are not registered with the SEC, right? So those small and mid-sized advisors, perhaps that you're taking a look at, they are still subject to the federal anti-fraud laws, right? So under the Advisors Act, there are anti-fraud provisions, and so those are still applicable, as well as state anti-fraud laws for that matter. And then I would also underscore the fact that advisors are fiduciaries, whether SEC registered or not, or SEC or state registered or not. And so you still have the duty of care, duty of loyalty that apply to the advisor's relations with its clients. So yeah, I think that's the broad scope of what we intended to cover. I know it's technical and we threw it at you quickly, but if you all do have any questions, we're happy to answer. I'll leave it at that.
Thank you so much, John. That was actually incredibly helpful. And given the complexity, we probably can't go over this enough times. So definitely want to open it up for Q&A from the committee.
Well, I will say too on that matter, and before we open up to Q&A, which we're of course welcome to, the one part of your introduction that you didn't mention with respect to my background is that I used to be with OASB, the Small Business Advocates Office that's hosting this meeting. And so on their behalf, I will point out that they do have really good informational materials on the SEC website that go over this. So to the extent that you're scratching your head afterwards and wondering, what he's talking about with the Company Act and the Advisors Act and the capital raise, how does that all fit together? There are a number of materials online that should hopefully be a good primer.
Can you maybe talk very briefly just to educate the committee on 100 is not 100, 250 is not 250, look through rules, just so as we're thinking about, the number limitations?
100 is not 100.
Right. So I may look at a fund that has 100 LPs, but each of those LPs has different beneficial owners. So it's going to get me over 100.
Oh, I see. Okay, right. So that gets into pretty particular facts and circumstances that I don't necessarily want to cover in detail right now, just because I don't want to, give you any sort of technical information that later proves that needs to be tweaked. But I will say that, to the extent that, you have an LP coming in and it was formed for the purpose of investing in your fund, and it itself otherwise has a number of LPs, then you're right that there would be a look-through mechanism in order to sort of clamp down on the clear circumvention of the rules. So, well, I'm not going to provide tons of specifics on that. I do think it's a great question because it gives an opportunity to underscore for everybody else that this is something that the securities laws are generally aware of and attempt to mitigate. Right. So point being that you can't have a fund that comes in and says, oh, I'm only one LP, but then it itself has 100 LPs, and that's a way to get around the rules, just to be clear for everybody.
Thank you.
And John, just one quick question on the $12 million limit for the that you could go up to under C1, that you could go up to 250 if the fund is less than 12 million. How did you guys come up with the 12 million number? Like, where is the origination of that was set as the threshold?
That's statutory, Robert. That's right? That's the 12,250,000 limit is found in the Investment Company Act itself. And so, to the extent that, you want to push and pull there, it would typically require congressional action.
Yeah, I'll add that I think it used to, I need to double check this. I think it used to be 10 million and then it was recently adjusted up to 12 million.
That's right.
I need to double check whether that was just to reflect inflation per the statute or if there's another reason. I can double check that real quick.
And what's the original age of the statute? In other words, how outdated are those numbers?
I think the original one was 2018. Isn't that right, John?
So it's pretty recent.
Yeah, I think that's right.
I'm actually not sure the vintage of the statute, though. I will say it is recent, and I just checked while we were in that brief reprieve for me, and it is found in the Company Act. So I did want to highlight that it's statutory.
Hey, John. Just real quick, under the qualified VC funds, you mentioned limits on redemption rights. Can you just at a high level summarize what some of those are?
That is Herbert, thank you for the question. It's a, I'd have to go back and take a look at the particular rule. Yeah, just as a, I don't want to necessarily speak to my experience in private practice before coming to the commission. So to the extent that I gave you information on the specific strictures, I'd want to take a quick look.
Okay, thank you.
Great. And as the VC fund exemption of 3C1 is something that we're exploring, do you have thoughts on pros and cons of raising the 250 beneficial owner or the 12 million AUM limit?
Sure. I love that you ask, and thank you for asking. And I anticipated that somebody would in fact ask, either by means of formal preclusion or just a matter of general prudence, given my position at the commission. I don't think I can weigh in on that. Yeah, I'm sorry to give that as an answer, but you know, we want to provide.
You're like, thank you for asking, but I'm not going to tell you.
I figured that you'd ask, and as I was taking the subway in this morning, I was, believe it or not, that's the best. That was like actually a rehearsed response, and that was the best I have.
Okay, well, I'm glad I gave you a chance to do it. Well played. Jennifer, I think you have a question.
Yeah, I do have a question. Thanks so much, Erica. So, John, on the smaller advisors, is there a scenario where there's no registration required under the SEC, but there's no registration required under the state regulators as well? Because oftentimes the states also have their own exemption and exception, and so for some of those smaller advisors that don't really have that many fund clients, is there a scenario where they're not subject to either or?
Thanks for asking.
Or have you?
No. Thanks for asking. I understand the question. I'm checking my notes here because that is now outside of our direct purview. So, for example, it'd be a great question for NASA, the one with QAs at the end, not like rocket ships. So North American Securities Regulators. I want to say, and I'm going to caveat this by saying that it needs to be confirmed, but almost entirely, I'm going to say almost entirely, I don't remember how you phrased the question, but almost all small advisors will be registered at the state level. I think there were one or two states that did not necessarily have inspections, and so that's part of the rubric when we were looking at the mid-sized advisors, but that may have changed. And as it's outside the purview of what we do at the commission, I don't want to give you any information that's incorrect. So that would be a great question for them. Yeah, thanks. Jennifer, looks like you have your hand up.
Any last question? We are
a quick question. I'm just going to rephrase Erica's question. So if you want to use the same response, that's fine.
Okay.
But I'm just curious. I'm going to ask a little bit different way.
Sure.
From the raising of the 100 to the 250.
Yep.
Were there any implications that were negative that were a reason to look at to make us pause if we were going to think about raising the 250 to a higher number? Has anything happened because of the raising of 100 to 250 in the past?
I think not as far as I'm aware, but you'll have to take that for what it's worth.
Maybe I can jump in here too. I think specifically, and actually we were just kind of looking at this at the prompt of one of the commissioners, those specific thresholds. And I think, we're of the opinion that those are set by Congress, just like the 100, just like other thresholds in the statutes. And usually when it comes to something like that, we don't really try to make a policy determination one way or the other because we don't really see it within our authority to change those thresholds. So I think that's kind of where John's coming from, is that certain things are decided by Congress and we're left to implement them. But I don't think we have it within our purview to change those thresholds on our own. And so I don't think we really have a policy view one way or the other.
It's both there's both a process and a substantive answer to it. And so Robert laid out the process answer. which is that it's typically within the purview of Congress, and then also the substantive answer, which is what I'll repeat from earlier, which is that sadly, I suppose that we can't perhaps just by matters of prudence weigh in on the pros and cons. And
Thank you.
Right.
Sure.
Well, thank you so much, Robert and John. We really appreciate your time today, and I think we all learned a lot from this, and we'll continue to peruse the amazing information that's also available online to further deepen our understanding. And I want to thank everyone on the committee for these really great questions. And with that, we have the opportunity to take a short break before we resume our discussions at 11 a.m. Eastern.
All right, so long. Thanks, everybody.
Thank you so much.
I'll just remind everyone that the webcast is continuing to live stream, so make sure you mute yourselves, go off camera, and we will begin again at 11 o'clock sharp.
All right, so welcome back to everyone who's rejoining virtually and on the SEC webcast. We heard this morning a little bit about how challenging it can be for some fund managers, including underrepresented fund managers and emerging fund managers, to raise their first funds. We know that not all investors have access to the same network of peers, mentors, and professionals who can serve as potential LPs or provide guidance and support when launching a fund. Yet we also know that emerging fund managers play a key role in the US capital markets by funding startups everywhere. Emerging managers consistently report challenges raising investment funds, and women and other diverse managers report facing disproportionate challenges in raising capital. We hear similar challenges when we talk about entrepreneurs, particularly women and other underrepresented founders. And in that context, conversations can sometimes include considering what can be done to bolster entrepreneurial support organizations like incubators, accelerator programs, and other entrepreneur support centers. Similarly, some of the challenges facing emerging fund managers, particularly as it relates to building out their networks and providing resources and support as they seek to raise funds and refine their investment strategies, are challenges that could be addressed, at least in part, through fellowship programs and accelerator programs for fund managers, as well as fund-of-fund programs that provide support services. And they do exist. For example, I am a member of the Kauffman Fellows Program, which is an amazing two-year fellowship program for venture capital fund investors, as well as those who have either recently started their new funds or are thinking about starting a fund in the future, to really build out those networks in a very scalable way. I have had such an amazing experience from that program, and it's really improved my ability not only to manage my fund efficiently, but also to understand how to access the LP community that funds venture capital investors. So, to facilitate today's discussion to promote and support emerging and small fund managers, we're going to begin by hearing from an experienced fund manager and fellow Kauffman Fellow, class number 1, about how new fund managers can be supported through fellowship programs. So I'm so pleased to welcome Karen Kerr, PhD. Karen is a Kauffman Fellows board member and was a member of their charter class. I won't say when that was, but she's been doing it for a while. She's also managing director at Exposition Ventures. She was previously executive managing director at GE Ventures and is an early stage venture capital investor. I look forward to hearing Karen's insights as we explore how to address some of the challenges facing emerging fund managers and consider whether regulatory or other solutions could be implemented to further support these managers and, in turn, the early stage companies in which they invest. So, Karen, it's so great to see you. Thank you for joining us today. We're excited to hear about your experience and your thoughts on potential recommendations
Thank you so much, Erica, and thank you so much for giving me this platform to talk about a program that's near and dear to both of our hearts in the Kauffman Fellows Program. So let me see if I can share my screen. I do have a couple of slides, and hopefully folks can see the slides. In the time that we have, I want to talk a little bit about the program, the Kauffman Fellows Program, and some of our outcomes, and then maybe a little bit around the current environment for capital formation for emerging managers, and maybe a couple of thoughts around additional support.
And Karen, just wanted to really quickly mention, I know one of the topics that we were also kind of thinking about exploring is if fund of funds can be helpful to supporting emerging managers. And we know, you guys have had some experience there. So if there's, anything you want to chime in on that topic as well, we'd love to hear it.
Fantastic. Thank you. So in really in the to hit the highlight of what the program is, the program was formed about 30 years ago as a leadership program in venture capital. It was founded at the Kauffman Foundation in Kansas City, and it has since spun out and become an independent program. But at its highest levels, over those 30 years, we've gone from focusing around capital formation in one country, the US, to globally. We have almost 1 billion fellows. And what's very intriguing to me is that the program has really, from its foundation, supported diverse entrepreneurs and diverse fund managers. A third of our fellows today are female. I remember in the charter class, so that's like 29 years ago, we had 3 women out of 13 and 2 African Americans. And so from a percentage wise, that was far exceeding what you tended to see in the venture industry at that time. We've been a convener of both established and emerging funds in the program. Funds like Venrock and NEA and Canaan were parts of those beginning classes. And Venrock and Canaan are led by Kauffman Fellows today. Kleiner, which is a partner, is led by a Kauffman Fellow today. But we've seen that our fellows have gone on to found really the next generation of leading venture firms, firms like Emergence and 1350 and Mac Ventures were all led by VCs from the Fellows Program. So this is a snapshot of what our Fellows Class 29 looks like. We have about 66 fellows, and on average, that's about what we've got per year, kind of that 60-ish, up from 13 when we first started. And I think that really mirrors the rise in the venture capital asset class. But what I point out here is the gender diversity. 45% of the class is female. And the high representation of underrepresented minorities. That's 21% of our US-based fellows are either Black or Latino. And so we've consistently done that through the years. We've got, so in class 29, if we look at it, we have over 50% of our fellows are coming from emerging funds. And this is actually relatively consistent over our lifetime, but we're just looking at here the last 5 funds or so. You can see that emerging funds tend to represent somewhere between 40 to 60% of the class. We do have established funds. Over the years, we've added some corporate funds. We've added some limited partners as well, and we'll be expanding the limited partner network. Really, all in an effort to really expand the range of types of firms that are in the network. And actually having access to LPs, I think, has been one of the things that our fellows coming from some of these emerging funds and even some of the established funds have valued. And then we also are looking a little bit at what's the AUM of the funds that we have in the program. This is for class 29, but you can see sort of median average of where they are from both the emerging funds. So we do have a couple of fellows who are, we call them fund zeros, either because they're just starting off in their process or haven't fully closed the fund yet. But you can see that, you know, the median fund sizes are kind of 50-ish. And that maybe have some relevance to our later discussion around the limits around some of these general solicitation funds. So let me just talk a little bit more in detail about the program now that we know sort of who is coming into it. Really, this is meant to be a platform for lifetime learning in venture. I view it as a graduate level education in venture. Obviously, like any graduate program, we spent a lot of time recruiting the best of the best, and we think we've done that. Then there is a formal 2-year program, which consists of both in-person and virtual modules, where we'll do structured curricula with experts and practitioners. We'll do a bunch of peer-to-peer learning as well. And then we spend a lot of time focused on this network component and bringing our fellows together even post the program. And that's been an important part of getting value out of these as well. So in terms of maybe some of the networking and lifelong learning components of it, we have started special interest groups where fellows, both in program and alumni, are able to come together to share best practices and deal flow in specific topical areas. We also provide an infrastructure for more regional support of our fellows, whether that be, we've got a lot of fellows in the Bay Area, but we increasingly have fellows in the Midwest, the East Coast, and Europe, and internationally. So we're creating forums for them to convene there. And then we are doing regional gatherings and global gatherings as well. We do an annual summit that's bringing together 300 plus fellows out of our networks that we move around the globe to look at venture capital in different regions. This is just an example of where people make a lot of use of the virtual aspect. It's a great way to tag up with folks on topics. As you might imagine, at 30 years old, the program has evolved in that 30 years. I would say in the first epoch of the of the program, when it was run by the Kauffman Foundation, we tended to focus more on fellows who were early in their careers in venture, and were looking to, we were matching fellows with firms, and the foundation itself was paying all of the freight, and the firms were paying half of the freight. In the second epoch, the program spun out of the Kauffman Foundation, and we made it more of a 2-year tuition program. We also, that allowed us to go international as well. And then in stage 3 of the program, we've become more intentional about the network and programming for the network. So the 2-year program itself has evolved as well. Today, we've got about 40% of that. As our managers have become more experienced, they're doing more of the peer-to-peer leading and learner leading groups. And then we've got 40% that are more of a lecture with keynotes and experts in the industries. And then we have some workshops facilitated by experts. And so if we think about sort of what the modules tend to cover over the course of the 2 years, we've always focused on leadership and personal growth and development. And then we think about some of the fundamentals of doing venture. How do you source and choose and mentor companies? How do you add value to your entrepreneurs? How do you build your firm and think through succession planning? Indeed, this topic is perhaps the reason that the program got started in the beginning. And then we've also leaned into this notion of venture capital is really one of the most powerful tools for economic development and for positive change in the world. And we're really wanting to help our fellows and give them space to think through how they manage their own impact and how they can lead with purpose. This is just a highlight of some of our fellows and their journeys that they've taken. I'm going to just call on a couple of these groups. Jason Green was my classmate in the fellows program. He started his career and his fellowship at Venrock. He went on to found Emergence. He is now retired, as it were, from Emergence, but has started a foundation where he is now investing in diverse emerging managers and in some ESG related efforts, and really has been a real leader in terms of giving back. He was on the board of Endeavor, which really sought to promote entrepreneurs in outside of the U.S. It's become a global network for supporting entrepreneurs. Jennifer Fonstad was also a fellow circa my era, who went on to found things like All Rays and Broadway Angels. I mentioned that our fellows have gone on to now lead some of these storied venture firms. Brian Roberts is now leading Venrock. Mamoon Hamid is leading Kleiner. And then we've got fellows who are focused on the art of leadership. And Matt Mashari, who was circa my era, is created Mashari methods to work with entrepreneurs. Ravi Mohan similarly works a ton with entrepreneurs as well. So when you've been around for nearly 3 decades and have 1,000 fellows or almost 1,000 fellows, you have a great data set from which to do research. And I think some of the research that we've started to do is just how well are we doing in terms of our ability to train or to accelerate, to high grade venture capitalists. And so we're defining success really as being able to consistently find and invest in and support and exit category companies that are category defining or firm defining. And then our metric for that is unicorns. And so a company that reaches a unicorn status is what we might call category defining. And if we manage to exit at a unicorn valuation, that's firm defining, because at the end of the day, venture capital is a returns business. So that's kind of our methodology to it. So we've created something that's akin to an alternative to the Midas list, but our Kaufman list. Why we choose, and a unicorn, for I think many of you are aware, unicorn is a company that's achieved $1 billion valuation. We choose unicorns as the metric here because they're actually remarkably persistent, but they're really only 1% of the companies that get invested in. So if we look at a period from 2016 to through June of this year, probably 250,000 companies done, and less than 1% of them get to this unicorn status. And those companies tend to be pretty persistent, and that's why we think it's a great metric. Half of unicorns are in the US, 25% of them are in Silicon Valley. But interestingly enough, or perhaps not particularly surprising, is the fact that of these unicorns, 20% of them have at least one Kaufman fellow on the cap table. And 20% of our Kaufman fellows have been involved in unicorn type deals and exits. There's a fair bit of deal sharing and collaboration that goes on, so we do take into account some of that double counting. But we have been, I think, generated excellent results for investors through our fellows. 850 total exits, and 2/3 of that have been unicorns, and some $300+ billion. And so I think that really just speaks to our ability, or the success the Kaufman Fellows program has had in producing leaders in the venture capital industry. Just in terms of some of the challenges, I think a lot of this discussion has been on capital formation, and that's really no surprise. I think in more recent times, we've certainly seen a tail off in a slowdown in dollars going to venture in this post-pandemic, post-zero interest rate environment. I think that's disproportionately impacted first-time fundraising. Typically, you might see more first-time funds or early-stage funds, so funds 1 through 3 being raised in terms of number than more established firms. I think this is the first year we've seen that reversed. And to the extent that LPs, whether they be institutional or high net worth, are committing dollars to the asset class, we're seeing, of late, a disproportionate, better than 80% of it are now going to established managers this year. I mean, part of that slowdown has to do with the lack of liquidity in this asset class, but even though there is a lack of liquidity, to the extent there is some, it is tending to go to more established managers at a disproportionate level. I think a little bit of that is, folks might call it a flight to quality. Institutional investors are certainly looking to support their existing managers. And while emerging managers do outperform established managers, I do think there's a dispersion. There's a greater dispersion, certainly post great financial crash, in the performance of emerging managers. The other thing I think that's driving the fact that so few dollars is going to the fund ones these days is that disproportionately those dollars are coming from high net worths that are a lot more sensitive to some of these liquidity issues. And then maybe the final thing chart that I'll say is somewhat alarming. But I do think the Kauffman Fellows Program is positioned to help here, at least for our fellows, is we are seeing a tail off in terms of the number of funds that are able to secure second follow-on funds. But I do think that having those networks, getting into great deals, will help on that point. And then in terms of some of the topics that we have been talking about here, this $12 million threshold may in fact be too low. We are seeing funds in these in the emerging manager stage that have higher AUMs even at that stage. And then I think everybody's bemoaning the lack of liquidity and the challenges of getting public. So that's what I've got from a formal presentation, and I'll stop sharing and go from there.
Thank you so much, Karen. That was really, really great. And, I just want to say that this wasn't really planned, but, seeing how Dr. Howell really highlighted the importance of networks in successfully getting off the ground, and the work that, Kauffman is doing, that ended up, I think, being a really useful overlap for us to think about. But I think Caritha had a question.
Yes, good morning, ma'am. I'm the court reporter. I was told to join the meeting. Hello, can you hear me?
Yes. Hi, Caritha.
Hi.
Sorry, Courtney. Do you know?
Yeah, sorry. Hi, Caritha. Let's take this to the private chat. Thank you so much.
All righty.
Karen,
Okay,
I've got a
thank you.
question. Oh, sorry. So I noticed as you were going over sort of the fund size limits, and I noticed on your last point you said that you think the 12 million may be a little bit low. Could you maybe go into a little bit more detail, around why probably bigger fund sizes are more viable given sort of the cost structure of a firm and the fees that are associated with it, as to where you are seeing, even for a first-time fund, kind of where the minimum level of critical mass is?
Yeah, thanks for that question. I mean, I run an emerging fund. I'm on a fund one now after years of being at other funds. I finally launched my own firm. For these funds typically have somewhere between 2 and maybe 3%. Emerging funds can typically get away with 2.5% management fees. And out of that, you certainly have, personnel costs probably eat up the vast majority, or at least half of that. But you'd certainly have a lot of expenses around audit, legal, travel, so as you think about how to build and scale and build in infrastructure, build in marketing, build in a lot of things, having a larger size fund just gives you a better base to go out and build your organization to be able to provide value to your investors, to make better investment decisions, to see more, and to attract more companies.
Yeah, thank you. Eric, I'm sure you got thoughts on this as well, but I mean, just in terms of maybe give a little bit of indication of, like, you know, when we talk about like how much staff the ordinary fund has, because I do think that's sort of a critical point of there is a sort of like minimum threshold for which raising a fund kind of becomes viable, and you know, really even a $25 million fund for an emerging first-time fund advisor especially, like, doesn't leave you with many resources to run the fund, and anything less than that is like really even harder, disproportionately harder.
Yeah, and I think, you know, Bart, one of the things that is interesting to think about with that, you know, I would say that probably, like, I don't know, maybe 25 million might be kind of like a minimum viable fund size. Probably a little bit more if you know, have investors that need to audit. But there is an interesting perspective to think about, that the ability to even, you know, run a fund like an MVP proof of concept fund that is smaller or smaller than 12 million means that you possibly do already have to have money to support yourself. So that might be another factor that also makes it even harder for people who are coming from not wealthy backgrounds to be able to even do that first small fund and still eat food. So Karen, would love to get your perspective.
No, I think that's exactly right. I mean, from just some personal experience, we're at about 11 million, so we're kind of at that number today. I have one principal, part-time CFO, so that's infrastructure that you got to pay for out of the management fees. I do have institutional investors, so I do have to pay auditors, and it does mean, you know, launching a fund really does require thinking about no income for 2 years to get it off the ground. And if you're not at 25 plus million, maybe 4 or 5 years of no income, because so that you can build infrastructure to raise a second fund. So I think that's a great point. And you still have to be out there. So there are expenses around conferences, travel, what have you, that you can't push all of that into fund expenses, because at the end of the day, fund expenses are also just a loan. You still have to cover that in your returns.
Great. I'm sure more committee members have thoughts or questions. Please jump in. All right, great. One thing I would just love to get your perspective on. So two things. You know, one, and I mentioned this kind of at the beginning of the presentation. I know that you know, we as a committee have sort of talked a little bit about the ability of, you know, potentially fund of funds to serve as a mechanism by which perhaps more, you know, sort of emerging managers can get access to the type of, you know, institutional oversight that might, you know, make it a little bit easier for them to raise additional money from high net worths. You know, one of the things that we kind of didn't talk about today is that when we look at a lot of fund ones being, you know, largely comprised of high net worths, you know, it's relatively difficult to, you know, do, as we say, herding the cats, right? Which is to get many small investors to kind of all come in simultaneously to the point where, you know, you sort of have enough critical mass to support the expenses of the fund. So talking a little bit about, you know, are fund of funds valuable in that way to potentially, you know, provide like more traction for these fund managers. And then number two, you know, I know that Kaufman has, you know, had some experience working on a fund of fund concept. You know, in my perspective, it seems like Kaufman would be the ideal platform to manage a fund of funds just because of the sheer access to and, you know, very high depth of information on the managers that go through the program. You know, are there any sort of regulatory changes or improvement that you think could have perhaps made that process easier for a program like Kaufman to be able to get off the ground? Or were there things that came up that, you know, maybe provided undue challenges besides sort of LP demand?
A couple of thoughts on that. Thank you on the fund of funds. Thanks for reminding me to come back to that. Capital sources for fund of funds are quite interesting. I think the Kaufman did help to stand up a fund of funds early in its as it was transitioning to becoming an independent fund. We helped launch TrueBridge. And that's helped to provide some both funding for the program and scholarship support going forward. TrueBridge was very much a traditional fund of funds, as one might think about it, where the vast majority of their dollars was raised from larger institutional investors, many of whom struggle to deploy capital into venture funds because of their need to write larger check sizes. And so that is one thing that we've helped to do in terms of launching that one. And they do now fund of funds can invest in established managers as well as emerging, but TrueBridge certainly invested in many emerging managers and has done well there. I have seen some of our fellows do something interesting, which maybe speaks to this 250 person limit or sub 250 limit, where they have put together special purpose vehicles, pooling their resources with respect to networks of high net worths, and gave them access to a set of funds. And that's actually a pretty interesting idea because at the end of the day, you are trying to create a portfolio and maybe mitigate some of that risk by having a number of companies. So I do think that's a pretty interesting one. The Kaufman Fellows Program itself has given some thought to running its own fund of funds and establishing its own fund of funds for the benefit of investing in our fellows, recognizing the fellows have great performance. We're doing a lot to provide infrastructure and acceleration. We continue to explore that. We haven't taken it off the table. I think as we've gone into an environment where fundraising in general has been more challenging, that created its own headwinds for us in terms of getting a fund of funds off the ground. But we continue to explore that, and we think that can be helpful to our fellows.
Great, thank you. All right, wonderful. Any other questions from the group? Okay, all right. Well, thank you so much for your time today, Karen. That was really helpful and informative, and we very much appreciate your insights. And hopefully we can help create some recommendations that'll make everything, you know, a lot easier for everybody. So your input is really appreciated.
Thank you. Thank you for having me.
All right. Have a wonderful day. Okay, great. So with that, I am excited to open our policy conversation, and we can turn back to the topic from earlier this morning around VC fund managers' use of 506B versus C as a capital raising pathway. So would love to hear from the group. Any thoughts, ideas on how well you think the current rules are working in practice and whether or not there are some areas where we think there could be a bit more flexibility.
Erica, this is Rose Standifer. One thing that I didn't hear in the prior discussion around negative signaling, not the absolute sort of compliance burden of looking at tax returns to verify accredited investor or using a third party to verify, but as part of the negative signaling is also the risk profile of using C versus B, and maybe working with the gatekeepers such as advisors or lawyers that are talking to emerging fund managers about the risk profile of the C, specifically around fraud. And the fact that when you're raising within a network, VC is an inherently risky business model. If you're raising within people the threshold of dispute is just naturally higher. If you're raising with people that you don't know and something goes wrong, your risk profile is greater. And I didn't hear this being discussed, that it's not the technical rules of how to verify an accredited investor, but instead it's having a business relationship with someone in arm's reach in an inherently risky field. And we have other tools in the regulatory scheme that deal with this, certain safe harbor languages. You're never going to get rid of fraud, but is there other regulatory pathways to get people comfortable that things don't go south, they don't know these folks, they're immediately going to get sued, even if, because accredited doesn't necessarily mean sophisticated, right? So I feel like that's a missing part of the conversation that very routinely happens. I kind of had a network, I don't, here's the risk, here's not, of going 506C. It's not always just the pure cost of confirming someone is accredited, but it's assessing their sophistication in an inherently risky business model.
Okay, great. And I mean, do you have some suggestions on, how we could mitigate that sort of information cost in the transaction, or alternative methods to potentially create trust while using 506C?
I think it might be around the nature of the general solicitation that's done, and perhaps borrowing safe harbor language that is used in public markets, and really leaning into that around forward-looking statements around risk, right? If you can both talk to the emerging managers, as well as the gatekeepers that are advising those managers, that you're not inherently taking extra risk by doing business in a very risky sort of business model with folks that you don't know personally or that you don't know through your network.
Yeah, interesting. I mean, I think, you bring up some good points. One of the issues that I would have potentially, I mean, and, you can do things in a variety of different ways, but traditionally, since, venture capital pooled vehicles are blind pools, so, there is no forward-looking statements really, right? There's no expectation of anything that's relatively concrete, but also because the money is deployed over a lengthy period of time, it is quite a big counterparty risk for a venture capitalist to take on a limited partner that they don't know very well, because they have no idea whether those people are going to credibly perform on their commitment. And, if you have LPs that you don't know and they start defaulting on their commitments, especially if they're just, people that you found online and didn't check into their background very well, it puts your vehicle at risk quite a bit. So that could also be, a big part of why, there's negative signaling. Because if I'm an LP in a fund and I know that you don't know the other LPs in the fund very well, there's now, the negative signal that the entire vehicle could fail and not be able to meet its capital commitments.
Yeah, I mean, it's the other side of the same, it's the same issue. And, I'd love to hear just, are there structural regulatory pathways to deal with that sort of on both sides? Because we're looking at the network effects as not only the ability to find LPs, but the network affects the strength of those ties to actually facilitate the business model itself, right?
Yeah.
Like, you have confidence that the fund manager, that the LP will in fact honor the capital call. You have confidence that if you don't have great exits because of macro and microeconomics, you're not going to get sued, right? Like, so exploring how can we address that within the structure of the funds?
Okay, thank you.
Wanted to add on sort of a related point. I think in the verification side, that's something that that process is likely changing now, with improved technology, with a lot more kind of platforms out there trying to help funds find LPs, help accredited investors find potential investments. And my sense, having just experimented a little bit, but I think there's others here who probably know more, is that this is kind of a changing space, and there are probably some structural barriers to those, platforms working as well as they can. So, I wonder, and this might be something to think about as a topic in the new year, is to kind of tease out, like, how are these funds doing these general solicitations? Are they relying on platforms at all? Is that of interest to have that growing, and what are the barriers? Or, are they using events, or, exactly kind of what are they relying on, and what could be sort of functionally better to make that easier?
Can I just add to that, that, I really do wonder how they're doing the general solicitation, because if you think about, I've talked to some people who have registered as a 506c, and if they put it out on social media and things like that, they didn't really get LPs because of that, but did it give them, I don't know how to say this, almost like a false sense of confidence that they could go out to a network, or they could go out and start to talk to more people. And then there's almost like they kind of fell in between a B and a C, but they were a C, so they felt more comfortable because they were going out and doing general solicitation. Because I mean, people don't buy a lot of things just because they see it once on a social media platform. So, what was really the trigger of the general solicitation that did help these funds is kind of what I'm interested in knowing.
And I can, Marcia, that's a great one. I can weigh in at least a little bit from my personal experience on how I've seen 506c used. And it doesn't tend to be sort of like the mass advertisement. It tends to be more, I want to tap into an existing social network and sort of basically send a mass email out. So think about like a alumni network for a university, a college, some club or something like that that may have hundreds of folks, and you want to say, we're establishing the, ABC University Angel Network, and we've got deals to do or something like that. That's where I've seen 506c sort of kick in. It is trying to piggyback off of that existing social network, but a wider one than sort of direct communication, so that at least as a lawyer sort of advising, sort of saying like, that is Yeah, that doesn't seem like direct communication. That seems like a bridge too far. You got to go to 506C if you want to sort of spread the message that way.
Interesting.
That led me to a thought when I was reading the data and the results around negative signaling. What if it wasn't this bright line, I have to choose 506B and it has to be very strict, or I'm going to go 506C and I'm going to send out these broad emails. I'm going to actually put up deal terms in a pitch room when I don't know everyone there. And what if it is just general solicitation is allowed under 506B, and it's adjusting perhaps the unaccredited investors that you could have in a deal with general solicitation? Would we see more uptake because you're taking away that negative signaling? Because I agree, in my experience, a lot of these kind of fall within 506C and B because of the things that Eric and I were talking about. It's rare for a small fund that you're really going to take a flyer on an LP that saw you and you have no connection with them. But you maybe now go to third, fourth, fifth degree connections in your network by utilizing 506C that you wouldn't have gotten to if you really stayed center of the course under a B. And so is it collapsing? And then if you collapse, how do you deal with all accredited investors allowing some non-accredited in?
So, Rose, I think that's a really good point. I mean, from my understanding, and Stacey, Courtney, please correct me if I'm wrong. The main difference here is that you can still do that. I mean, yeah, I get it. Like, I guess the negative signaling would apply in both cases if you allowed it under B, but the main extra step is that you have to do some verification because you've now reached out to people that you don't really know. And so to me, that seems like a reasonable cost to protect the investor. Would you be comfortable with the idea that, you could now sort of reach out to people that you don't know and you also don't need to take reasonable steps to verify accreditation, or are we kind of going in a different direction?
I guess I challenge the notion that the cost of, like, the true cost of the verification is a burden.
Yeah, I don't think so either.
Right. I think it's the perceived negative signaling of having to do the verification that is a burden. I think the tools already exist, as Jasmine pointed out. I think they're even getting better. As a lot of those processes can be, automated. The fund manager never has to touch an accredited investor's financials to do that verification process, right? There's third parties and services that they could use. And I also think, a lot of folks that are, if you remove the barrier that I only have to talk to people within my network and I have a cachet, and that's no longer a thing, I think you're going to get uptake. I think you are going to see experienced managers even talking more broadly, right? Because they want to expand their networks. They want to get more LPs. They want Fund 4 to be 5 times as big as Fund 3, right? And I think that could remove negative signaling and actually help the emerging managers along the way.
So I just have a question because, would love to get a better sense of it. I'm not sure that the majority of the negative signaling is around cachet necessarily. From my perspective, I would think that the majority of the negative signaling is around counterparty risk in a partnership, right? Because we have to remember that venture capital funds are partnerships, right? They're not structured like other companies. So just, if, in my mind, whatever negative signaling is there really revolves around, I'm concerned if the general partner does not know the other LPs well enough and hasn't, necessarily verified their accredited status, that this presents a risk to the entire partnership. I think, to me, that's where most of the negative signaling comes from. And to me, that risk seems valid, right? It's not just sort of like invalid negative signaling that, oh, you're not cool and you didn't know, other wealthy people. So, I'm wondering, is there a component of the negative signaling that we think is material and not presenting a valid risk to the other investors, that the other LPs haven't necessarily been validated with reasonable efforts as accredited? And Bart, I think you had some thoughts.
Oh, so I agree with that, and I think a lot of that also kind of goes back into sort of the fund size limitations, right? So there's also the folks that you don't know as well but aren't, sort of in your direct network are probably going to be smaller investors. They're probably not going to be writing a $500,000 check, $1 million check. And if we sort of have a minimum fund size limit, we sort of talk about a 25 million, we're sort of limited to 100 investors. And so now, I mean, I think that does sort of put overall pressure, and you're going to people and you're asking to write really big checks. And so sort of, you're not going to get $1 million check on a general solicitation very often. So I think that's also some of the pressure going in that direction, which keys off a lot of these themes that you're sort of highlighting. The other thing that I kind of want to go back to, and this is diving too far into the details on 506C, but we keep talking about the additional incremental burden of the validation. And I think, and from a practitioner perspective, like, it's not that big of a deal, but it is another step in the process, especially if I have to involve a third party into the process. And keying off of one of the things that Emily said, and it's been a while since I've dove really deep into it, but I don't think the SEC has ever formally said that you can rely on an accredited investor questionnaire or self-certification. That's been very prominent throughout sort of the 506B realm. And so at least from the practitioner side, I've always sort of interpreted the guidance from a C that it needs to be something more than just self-certification. If a self-certification through an accredited investor questionnaire were sufficient, then I do think that would further reduce the friction on it. Because you're not having to get a third person involved, you're not having to ask a investor to give you their W-2s or a net worth statement, which is sort of like a deeply personal question, and so that has a lot of social friction in it. Again, I think that may be a little bit of a side issue, but at least kind of get into the direct, topic that we talked about, the additional transaction costs. It's a little bit higher than it would otherwise see, just because sort of either the transaction time or the social cost to it, at least in my experience.
Yeah, Bart, I mean, I think that's a really great point, possibly bringing up the social cost. So interesting idea. I kind of, I feel like there's two sides to this coin, right? Which is, okay, it sounds like the reasonable steps are not exactly onerous, right? They said it could be an email from another person, or as you said, they could submit a tax return. Maybe we could sort of dig into the details. So on the one hand, I do agree with you that it's reducing the social costs, and so there's some upside there. But then also on the other hand, does it make sense for there to potentially be, some social costs and not make it just too easy for people, to jump right in on the investor protection side, right? Because I would think, okay, if I'm literally going into partnership with somebody on a 10-year business, I should probably be willing to, provide them some evidence that I'm actually accredited. So that's just the thought that I would have.
which is that we
I
sort of do want to minimize friction, but at the same time, like,
Mhm.
these are relatively long-term, commitments that you just really can't get out of. So, does it make sense to provide some reasonable barrier to people entering too quickly?
Well, I 100% agree, but I think that exists in B or C. And I think that's the reason that even in B offerings, we often do have these big investor questionnaires where we're asking those. I guess one area that, and maybe some folks from the SEC or some of the other practitioners can weigh in on, one of the statements about it is okay just to rely on an email from another accredited investor. Like, I don't know that that is definitively okay. I mean, so part of it is like there is this fuzziness of, let's say that we are in reasonable steps to verify territory. There's a little bit of thought that the lawyers have to kind of go through and look at each individual one. And I don't think there's been clear guidance to sort of say, yep, self-certification alone is totally okay, or referral from another accredited investor is totally okay. So some of those statements, I don't know that, somebody correct me who's deeper in this as well, but that we could, that are, you can like just take for face value as, oh yeah, definitely every time that's all you got to do.
Yeah, I mean, it feels like, on the surface of it, to me, it feels like self-certification for 506C seems like actually a really good idea because, it does mitigate some of these things that you're saying. I'm just trying to kind of like imagine the scenario. Is there a scenario in which, unaccredited, unsophisticated folks are just told, oh yeah, just sign it. Like, you're going to be rich. You're going to have that much after you, just do it. Like, don't read the fine print. That's the only thing that I'm kind of like thinking, like, I could totally see that happening, but would love to get other people's thoughts.
Yeah. I just wanted to add too on to your point, Barton and Erica, about the trepidation around having to walk through that process and go through that verification. I've seen it especially with communities that rely heavily on foreign investments, and so there's a lot of hesitancy to get them to fill out that form, even though it's administratively it's not that significant of a burden to do. There is some trepidation there, and I don't know if it's just a lack of distrust, with just dealing with the U.S., but I know that firms and issuers are often hesitant that it's going to cause a little bit of delay, and that they may potentially lose the investment if the foreign investor is not comfortable with the level of inquiry in that questionnaire. And so I've seen it come up with a lot of communities that rely a lot on foreign investments because it's just more information that they have to disclose. And to your question, Bart, what I've seen folks use in the industry is just a standard, a questionnaire, that seems like a lot of law firms use the same sort of format, and even some of the new emerging platforms go through the same process. But I don't know if it's the administrative piece that is the deterrent, or it's just the fact that it's another step that folks have to go through, and particularly if they're out of the country, if they're foreign, it's not something that they're often excited to do.
And can you give us a sense of, you said communities that rely on foreign investment. Which type of communities would these be?
Sure. Yeah. So I'm in Miami. I'm in South Florida, and so the demographics here are huge populations of Latin American companies, Latin American families that have ties to countries outside of the U.S. and Latin American countries. And so oftentimes there are opportunities in coming out of those countries to invest in startups here or in companies here. And so, while there is opportunity and access to capital, I know that a lot of our firms here are very delicate with those relationships because although there is a lot of capital there and interest, there's not a lot of tolerance for lots of process. And so it's very sometimes very delicate with handling foreign investors because they don't like to disclose much. And so that's oftentimes why you get some pushback, and it might be just easier for folks to get around it. And that might be driving the preference for the 506B as opposed to having to go through another administrative process, particularly for those kinds of investors who are not that forthgiven with information. So mostly, I would say in communities like South Florida, where there's a huge variance in the demographics in terms of the kinds of capital that comes. It's not just U.S. capital that comes from foreign investors that are abroad, and there's lots and presents lots of opportunities for a lot of companies here in South Florida. But it does create some trepidation when you create that new administrative burden of having to get more information on the investor.
Okay. All right, great. So, I mean, I think we have an interesting sort of groundwork for a potential recommendation, right? Which is that we are sort of balancing between, can you reach out to investors that you don't know? And if you as an issuer are going to take money from somebody that you don't know, should you at least take reasonable steps to verify that they're suitable? Do we want to say yes to that, or do we just leave the entire responsibility in the hand of the investor? So I think, that's one thing we can definitely talk about. I know that one of the issues, and as we're, I think we have about 25 minutes left for discussion, was around, this rule on the exemptions under 3C1 around ownership and AUM limits for these qualifying venture capital firms. And we talked a bit about, the viability of the 250 beneficial owner and $12 million AUM maximum. So do folks have thoughts there around a possible recommendation on improvements and why?
One of my thoughts there, kind of bridging the gap of these two discussions and thinking of investor protection, I think if you go bigger, so if you want to increase the uptake of 506C, and if you do, both for sort of economics and the check size that you're going to get, 250 under 12 million doesn't make sense. You're going to need to bring 250 up, and you're going to bring the new 12 million up. But does that still retain, right, this friction point of then having to verify and ensuring that everyone is in fact an accredited investor, right? And that is a friction point that you're building into the fundraising, but that's coming at the benefit of having greater access. You can raise for more people. You can have a fund that's bigger and still be not registered. And if you want to stay small because you don't want the friction point, right, there's a pathway there to potentially use general solicitation with, something less than, or maybe it is just the self-certification in a rep now, or maybe there's something in the middle, right? Like, is there a pathway that as a manager you can choose that you want this greater access, but it comes with potentially friction if you're going to have to verify?
If I can just add that what I've heard out in the field is there are angel groups that have fairly large membership, and if they do an annual fund or put some kind of a fund together, and they have more than 250 members, and all the members want to participate, that's one of the, like, it's just one use case of how they're kind of bumping up against these limitations. But to your point, Rose, in past meetings, we've talked about the accredited investor definition, and we did actually make a recommendation to the commissioners about adding an educational component. So I kind of wonder if we didn't have this all kind of marry each other, and maybe there was a way that part of this being able to certify if people are accredited would have an educational component that could maybe be an out of the box thinking of how we make sure that the people who are getting into the fund, to your point, Erica, about you don't necessarily want to take people who really aren't sophisticated or don't, haven't really done this before. They don't really know what they're getting into, that kind of thing. You don't want somebody a couple of years down the road saying, I didn't really understand this. Give me my money back.
Yeah, that's a really good point. And, Marcia, I'm all for education. We like to take classes. I know you and I are in that thing. I don't know that applies to the majority of people in this country. Unfortunately, I think, when I think about a barrier, certainly having it as an additive that, like, I don't know, if you took this class, great, but putting it in between people and investing, I think, if we look at, okay, show me your tax return versus take this class, like the take this class thing is probably going to be a lot more of a hurdle for folks. But, I do agree with you, as you point out, I think the concept of, funds that are kind of run by angel networks, operating, sort of in their own geographies to really provide that very early risk capital to folks that might be overlooked by the multi-billion-dollar fund managers. We certainly would want to create some regulatory frameworks under which they could operate with the least amount of kind of regulatory burden and expense. So right now we're looking at, they might be constrained. In fact, I think they would definitely be constrained with a fund that's 250 owners and maximum of 12 million. Do folks think something like, 1,000 potential and 25 is more of like a viable fund size? I know I haven't kind of been in the angel world for a long time, but back when I was doing it, a $25,000 commitment was kind of like the general rule of thumb, minimum commitment, to things, whether they were individual investments or not. To me, that seems a little bit more of like a reasonable size to accommodate, folks who are looking to put together small, simple vehicles that can take reasonable check size from a decent community without having a ton of regulatory burden on them.
Yeah, I agree. That's what we're hearing. It's almost like they want to put a fund together because they're over time, these angel networks end up with investor fatigue.
Yeah.
Because if an investor makes one or two, if you're over the accredited investor definition as far as your income or wealth, a lot of people are kind of just hitting it, or they're just a little bit over. They can't write, big checks over and over and over again. So, to get a diversified portfolio, they almost have to do some kind of a fund model. And I've seen so many angel groups over especially the last 5 years, add this to their repertoire. And that's, I think, where, it starts to get a little murky. So is 250, like, that's why I was asking, like, John, about, what was the difference between having 100 or having 250? Were there any ramifications? Did anybody see any like real pushback? Because then what's the difference between 250 and 500? What's the difference between 500 and 1,000? I don't know the answer, but you know, if we're really hurting these angel groups to be able to allow their members to participate and get that diversified portfolio, which we're always talking about being the best way to minimize risk, well, then we're actually like doing them a disservice by not having these limits be higher.
Yeah.
And also,
Oh, sorry, go ahead.
I was going to add on to also higher limits would allow for some smaller check sizes. So I think some angel groups actually to allow for diversity on the investor side, to allow more women and minority investors are actually lowering it even below the 25 that Marcia was mentioning to get a diverse investor base. So that has that benefit. And the other, so I would support like 1,000, the 250 going up to 1,000. And then the other thing I just wanted to circle back to, I think someone mentioned this briefly a little while ago. I think, you know, I do see some benefit to collapsing the 506, the B and C, such that you know, having just kind of one pathway where you can choose whether you do a general solicitation or not, and there isn't that signal. And I understand Erica's point that maybe we want the signal in certain situations, but there might be other ways to get that signal. I mean, these funds, you know, probably do talk about who all is investing. I'm sure that's part of the marketing and how many investors and so forth. So I do see some real benefits to like a simpler regulatory environment as well as kind of at least, you know, an experiment with what happens when you don't have this separation between the general solicitation and this kind of very narrow network path.
Yeah. Yeah, no, totally agree, Jasmine. So, you know, here's kind of a little bit of my thinking on, you know, why we would want to move the number to where we want to move it, and, you know, why not just sort of unlimited, right? So it feels like 250 and 12 is too small for a viable vehicle. You know, 1,025 is sort of closer to where a viable vehicle is, but we're still keeping it kind of like under the amount where there's enough kind of profit margin in it to attract people that might be fraudulent, right? Like no one's gonna, you know, get rich off of managing a $25 million venture fund. So there might be, you know, still keeping it, you know, within a reasonable limit. There'd be less motivation for people to kind of go out with funds of this size and, you know, potentially take advantage of larger numbers of people. You know, on the collapsing of 506B and C, I mean, I absolutely agree with you, you know, that it might seem like a more efficient way to get there, but at the same time, it would also, you know, include us kind of making a recommendation that, you know, kind of towards I think what Jennifer had mentioned, you know, that we're going to allow people to go out and solicit investment from folks who, you know, are allegedly on the one hand, you know, willing to join a partnership with you, but on the other hand, you know, not willing to provide sort of a reasonably low level of information that you don't know and you didn't know them previously. So I just think that, you know, we should not underestimate the risks that, you know, maybe we as, you know, law-abiding citizens, you know, might not be doing, but that could potentially be there, you know, and why, you know, those sort of edge cases that have required that reasonable steps of validation to exist. But I think, you know, could be interesting.
Erica, just a quick question. When we talked about the education piece, did we actually talk about requiring verification that they took these classes, or we simply had to point them to where the classes were?
We were pretty general in our recommendation. I believe, and Marcia should correct me, I think the Angel Capital Association has met with the SEC about more specific
Correct.
recommendations, right? Certifications.
Yep.
But we left it up to the idea is the SEC could approve whatever the program is, so they could have certain approved programs.
Okay, thank you.
Yeah, and I mean, I think, it's such an interesting opportunity because, yeah, technically it's like, okay, if you took this class, now you could just share the fact that you took this class. You don't have to divulge any personal financial information. But, the question remains like, are people even going to take the class? But I think it's a wonderful idea to have that as an option that allows you to like maintain privacy, but show that you've committed to, informing yourself about all the risks.
Okay. Well, and I do agree with marrying this body of work with the work we've done previously around education. That just seems to make sense, because if you decide to go to, what'd you say, 25 million at 1,000, so now you're dropping the minimum point of entry to 25,000 versus I think 48,000. So that's going to broaden the pool.
Yeah, and that's just average, right?
Yeah,
So.
yeah, that's right. Yeah, I just did the simple math on that one. Okay, thank you.
When you talked about education previously, was it for, all accredited investors? Was there a certain threshold? Because I think one of the tensions with this, does accredited equal sophistication in terms of investor protection? Where do we draw the line? Do we think that the actual financial metrics for accredited are perhaps on the low side, that they're not singling that sophistication, and we're concerned, just current economics, that doesn't protect them? Whereas if someone's going to come in as an institutional, right, as a quib, or your qualified purchasers that you're going to have in a 3C7, we don't have those concerns because they're sitting on such a pile of money. I mean, so did you guys distinguish between that when you talked about education before?
So we definitely talked about all of those issues, and how education is essentially a better measure for your ability to be investing in these investments than just your net worth. And so, but we keep some kind of accredited investor test that is wealth-based, but then we recommended that there be also and I think Stacy's put the recommendation in the chat. So if I misremember this, please check the documentation. But we said that you should also be able to use education, and I believe we had it as education plus the income net worth. I don't think we said just education, but you should definitely check, because it's been a little bit since we discussed it, and we were kind of looking at the crowdfunding ranges as sort of a basis, since they're more flexible than the standard.
Yeah, I think we had said, that you could use the education to meet the test, but then within that, we sort of recommended a sliding scale on, how much of your income you can actually invest. So opening it up, to people who have educated themselves, but maybe don't meet the traditional accredited investor test, with a limit around how much they can deploy in any 12 rolling months.
Right. Right. And so that was sort of as an alternative to the financial metrics. And I have this here, similar to what was with crowdfunding. I guess what I'm saying, and this doesn't necessarily create more simplified regulation, but in the fund context, let's say you have 1,000 people, it's 25,000, per check. You're able to get that through general solicitation. Is there a pathway for this type of issuer creating that fund partnership that it's still, you can't, you still have to have those financial metrics, but perhaps if there's some signal verification around sophistication or higher financial metrics, there's less hoops you have to jump through for verification. What I'm trying to find is there a middle ground between your 3C7, right, where you have all your qualified purchasers, you can have as many LPs as you want on the cap table, as big a fund, right? You can have your $1 billion fund, right? Versus what we're trying to talk about, access the crowd. Is there a middle ground that allows the emerging manager to get the fund size that they need that still has tight investor protection.
Yeah, so I think that's the 3C1 exemption, qualified venture fund exemption that we're talking about.
Right.
And
But
increasing that.
but also looking at your accredited investor threshold as part of that, right? Like if you're going to say you can do that, you're going to get there with a 506C, right? And we're concerned at some of the existing friction points that, I think Jennifer articulated well with a 506C. Is there some other threshold in there, right? Is there a regulatory middle ground?
Is there something that you're proposing so we could get a better sense?
Well, I mean, it would be, I'm looking at your prior, the prior recommendation on leaving the financial metrics as is. I think in that situation, would you actually increase the financial metrics of accredited investor? Right? Like if we're going to allow, so what we're hearing is, okay, we're going to allow, we want to go out and have general solicitation to increase access to the crowd. Okay. Do we want to level up the quality of the crowd that can invest? And when we think about that in terms of, financials and education, and I'm more raising this because I can, see the recommendation, but I don't necessarily have all the discussion that came behind that recommendation on accredited investor and whether or not it was discussed kind of in this context.
Yeah, so I don't know if the point of it was, no, we were not thinking about making it harder to qualify as a accredited investor. I think we were actually thinking about giving people more pathways to qualify as an accredited investor. But I think, here the friction is just, have you verified that they really qualified as one or not? Or are we just sort of letting them, say? So kind of counterpoints, but I think in a way that we think, protects both sides. But I don't know, Jasmine, do you have more detail on what our kind of intention was there?
Yeah, I think that was our intention, just to broaden accredited investor access. I mean, I see what you're trying to do here with this middle ground with the really large funds with, a lot of sophisticated investors, and something that's more suitable for angels. And I mean, I guess I'm wondering how much we really need. Like, I mean, I would let some of the angel investors, the investor group members in the room, like, I thought the groups do the verification. Like, how much do we really have to worry about verification part? I guess to me, it seems like if we just raise the number of investors so we can lower the average size, doesn't that kind of broaden access pretty well? Because verification's already kind of taken care of in those groups, but what am I missing?
Yeah, agreed. I did want to just mention that we have about 3 minutes left. And Courtney, do we still have a quorum if we would like to potentially vote on anything?
You do just barely have a quorum, but you need a simple majority for, a recommendation to pass. So that would be kind of a total consensus on what is proposed. Alternatively, you could propose something, it could be discussed, you could paper it, and the committee could discuss it again in February with the broader membership.
Okay, sounds wonderful. Is there interest from the group? So I guess we're maybe going to think about some sort of a middle ground between 506B and C, and see if there are some opportunities to minimize negative signaling. And I think perhaps in the interim we could really sort of do a little research on what exactly those negative signals are, and then 2, on 3C1 qualifying venture fund, number of owners and AUM. Do folks feel sort of good about the 1,025 million, or, you know, is there a reason for another number? It does feel like, you know, a 4 times increase and a doubling of AUM is pretty material, but, you know, if there are ideas on why we would go in a smaller or larger direction, I would love to hear that from the committee.
Erica, I think that's a really good thing because in a lot of the angel groups and funds and people I've talked to, that $25,000 number is very approachable for people who are especially first-time investors. So that to me would be like a really good sweet spot of and how we would say that the 1,000 and the 25 million makes sense, because over and over again I've heard that number from people. It's almost like 50K is too much, 10K isn't really enough to care enough to, you know, be invested for 10 years and really, you know, follow it and be a part of it and, you know, get involved. But that $25,000 number I think is a really good place. And so I think all the numbers make sense.
Yeah, I'll one sort of other point of clarification, just to you know, sort of reiterate one of the things that's pointed out before with regard to those two numbers, the 25 million, those would be statutory changes. So our recommendation for that would be focused more towards the legislators rather than the SEC. So I think that also gives us a little bit more freedom just to sort of try to put out into the ether, hey, increase it, and then you can go through the legislative process as well. And then to that end, I would say that what we heard was 25 million is probably the minimum viable fund size. So if we're going to set sort of the threshold, we probably want to recommend that it be higher than 25, just because if 25 sort of seems like the minimum, just to get the fees and cost structure the same.
Well, I mean, I think, you know, here's the issue. I think 25 is, you know, it's clearly not the minimum, because, like, you know, Karen said her fund is 11, right? 25 is kind of like, you know, a good viable fund size. I mean, I think part of the reason that there is a limit on size is, you know, once you're past 25, like, you have enough to be able to sort of support whatever regulatory expenses that you have. And the issue with making it bigger is, like, you probably want to keep it at a target size where it's not going to be attractive to people who actually want to scam. Like, a $25 million fund is just not going to provide enough management fee or whatever to make it worth scamming people. So, you know, that's why I would not recommend, you know, limiting. And for an angel network, you know, a $25 million fund that you maybe raise every couple of years, I mean, that can have an incredible impact on a startup community.
Yeah, so and I should have been more careful with my language. And part of this is also sort of reiterating the struggle that I see with emerging fund managers in particular. So take it outside of the angel group context, which inherently does have a little bit more admin structure, because you normally have probably multiple fees, dues, you know, there are ways to sort of offset it. But at least sort of regionally and in the underserved markets that I see, like, the biggest struggle that I see is these folks go out and try to raise $10 million funds, but that's not enough to give them a real shot at being a fund manager. And so that's why I was sort of saying 25 is the minimum, but you're right. That's a much more broader description of it. So,
yeah, I love that. By the way, love your painting.
Thank you.
Yeah, I'm supportive of the qualifying venture fund exemption, recommending going up to 25 with a 1,000 sort of beneficial owners for the LP base. I'm not sure that then still creates the problem for emerging fund managers of how do they find 1,000 people that are going to write the 25K check. I think that's, you know, there's on one hand, you have angel groups that kind of have this, but if you're a true emerging fund manager, you have the sort of the weak LP network. I think there's still discussions to be had of, if that is approved, that it's a 25 million limit and you can have up to 1,000 beneficial owners, how do we increase the ability? How do we encourage emerging
fund managers to actually go out and get those checks and LPs if they don't have it in their existing network. Yeah, I mean, listen, I agree with you. You know, I'm an emerging fund manager and that is my job. So that's their job.
Right.
You know, that's what they spend every day doing. And, you know, that's just the work, right? It's not meant to be super easy, and it certainly isn't. But, you know, I think what we're just hoping to do is not, you know, create, I think, excessive regulatory burden on those folks. So, but yes, it's still going to be really difficult. Like, I feel like that's not something that we can regulate away. But it's a really great point. All right, wonderful. So we're a few minutes over. Courtney, Stacy, anything else that we need to cover before our administrative session?
I have a comment.
Yes.
It's Dennis.
Hi, Dennis.
Hi. So are we talking about deferring the vote then until February?
Unfortunately, I think a lot of people have dropped off, so it feels like
Okay.
we might not want to vote on anything until we have more people. And I think it'll also be easier to vote on something when we're all together in person.
Yeah.
Does that resonate?
So the reason I mention that is because we might want to have some actual users chime in on their feelings about the subject. I mean,
Yeah.
some underrepresented fund managers, have them give their views.
Okay, I think that's a wonderful idea.
Okay.
And you're talking about people who've actually used 506C general solicitation to raise funds.
Yeah, CRB or CMB or.
Okay. All right, interesting. I mean, it sounds like most people are using B, and you know, maybe what we're trying to figure out is, are there ways to improve C? So it feels like we're probably maybe less familiar with people that have used C. I don't know what other folks think, if it would be interesting to hear from somebody who did it.
Yeah, Erica, I think it's more, you know, the legal team that we used, they're very familiar with B. I think it's just lack of awareness of C.
Yeah. So maybe we can find somebody who who used 506C and, you know, get a firsthand account. Yes. Would that be interesting? Okay. All right, wonderful.
Yeah.
If anyone, you know, personally knows somebody, you know, please let us know and we'll put them in the pipeline. Thank you for that. That's a great idea.
I can use Nancy Sims to find someone.
Okay, great. All right, wonderful. Well, thank you all for a really amazing discussion. I think these topics are vitally important, and you know, we're excited to hopefully come away with a vote on a recommendation at our next meeting. I also want to thank all of our new committee members. You guys added so much wonderful context and thought to the discussion today. We can already tell the committee is vastly improved by your presence, so thank you. Would love to announce to everybody, including those on WebEx, that our next meeting is scheduled for February 25th. So I certainly hope that you'll join us then as well and hear the continuing conversation. And I hereby move to adjourn the meeting.
Thanks, Erica. And then I'll just tack on, remind everyone there's a different link to come to the executive session.
All right. See you at the executive session. And we're starting that at 12:45?
Correct.
Okay. See you soon. Thank you.
Thank you.